95.
4528.95. Okay. Who is this, please? Who is speaking? Who is
Emmanuel.
speaking? Emmanuel. Okay. Any other person? In case Emmanuel is wrong. Who else again?
Wait. Sorry.
You can't tell them in class next week. Wait.
Sorry.
I'm
coming.
actually testing our accuracy skill and to drill us. If you don't know how to calculate this now, then there is a big problem. Oh. In case you don't know how to calculate this, there is a big problem.
1929.5.
1929.5. Who is speaking?
72. 73.
Eh? Who is speaking?
Perpetua. Me.
Any other person again who want to contribute again? Any other
1,929,000.
1,929.
7.3.
0.73. Who is that?
7.3.
Yeah, 1929.
Who is this?
1929.5.
Okay. Who is this person that costs 0.73? Oh yeah, who called 0.73 now?
1929.65.
0.5, Abby. They've called 0.5. You said 0.65, Abby. Another person, 1929.65. Who is this person that called 0.65? Who called 0.73? Oh yeah. Bukumi. Time is up. Time is up already.
Please, I changed my answer. Kazim.
Okay, time. Otilo, time is up. Time up. Oh yeah. So whoever win, you have to be smart. And our exam is next week, so no room for errors against her. So whoever win this one, the price is 2K. The winner collecting 2K. Maybe via recharge card or anyhow you want it. I will nominate who will give the price today. So, oh yeah, can you guys do these ones too? This one too, time is 2 minutes. Your time start now. You get these ones too. Price is 2K. Oh yeah, time start now. We want to try this. Calculate the value of a bond, 13% yield, annual coupon 12%, and a face value of 2,000, and has an infinite useful life. Time is, this is 5:25, 3:25. We stop by 3:27. Yeah, start. Stop by 3:27. Start.
Kazim, can I try?
Everybody can try, bro. Your time is going on. 1 minute. It's remaining 1 minute more.
1846.15.
1846.15. Who is this person? Ima?
Yes.
Another person. Who is calling answer again? Five seconds to go. Okay, time up. So, hello, are you with me? So let's quickly, hope you guys enjoy my starter meal. Probably we might still have our main course and dessert before we leave here today. So this is just starter meal. 4K is gone now. I hope somebody will win my fourth. Will win now. It's not mine. Our 4,000 naira. So I will just nominate anybody to pay this money for us today. And okay, let's see. So this is the answer now. So calculate the value of a bond with a yield of 30%, annual coupon of 12%, and a face value of 2%, and has an infinite useful life. So whenever a bond has an infinite useful life, the price of that bond is equal to your coupon divided by your yield rate. If it has an infinite useful life. So in this plan, our coupon is equal to, it has a coupon of 12%, right? To 12% on the face value of bond. So that coupon is 12% multiplied by 2,000 naira. So the answer is how much? If we do this, this will give us how much, please? 12% of 2,000 is how much, please?
40.
That's 240,
240.
Abi? 240. So your PO is equal to 240 divided by, yes, your yield is 13%. That's 0.13. So what's the answer? So the answer is, oh yeah, please, I hope everybody have calculator there. 1,846.15. So Ima is correct. Ima, congratulations, you have just won 2,000 naira. So in case you're a big boy that the money is too much, you can nominate somebody that we can touch. And if you want it, we'll give it to you. So oh yeah, let's do the second one fast. So I have 4 answers here. So this one's too. Solution. Okay. Solution. Our coupon is, what was our coupon? 12% on 2,000. So that gives us, our coupon is 240. Abi? So what's the price of our bond? Price of the bond. So you have to do your table. So we have year. You have your year. You have your cash flow. Then, okay, year is 1 to 5. Then you bring the something back in year 5. You bring the redemption price. You bring the redemption. So 1 to 5, you have your regular, which is 240. Then you bring your redemption value back in year 5, 2,000. Then your DCF be at what? Your DCF will be at your yield, which is what? 13%. Then you have your PV. So the price of the bond is this. So your DCF for 5 years, because it is cumulative now, you can do your cumulative DCF for 5 years. So how? It will be 1 minus 1 plus R, 1 plus R raised to power what? Minus N. Minus N, okay. Divide this by what? R. Okay. Divide this by R. Divide this by R. So we need to quickly calculate this. So this will be 1 minus 1 plus, it is our yield is 13, Abi. 1 plus 0.13 raised to power minus 5. Okay, raised to power minus 5. Okay, then divided by 0.13. Divided by 0.13. So what's it? Divided by 0.13. So what's our answer? In fact, your calculator can do all these things for you at once. So we have 1 plus 0.13 raised to power minus 5. Okay, minus 1 divided by 0.13. So I got 3.5172. It is 3.5172. It is Kobo that will determine the winner. Whoever is the nearest to my answer is the one I will give the answers to. So we also do for year 5. For year 5 is very simple. It is 1 plus 0.13. Okay, raised to power 5. So this year 5, sorry, raised to power minus 5, Abi. Minus 5. So this one gives me 0.54. 0.5428. It will be 0.5428. So what's the answer? 3.5172 times 240. I got 844.128. Then this one gives me 2,000 times 0.5438. This one gives me 11087.6. This one gives me. So what is the answer? Who is the winner? Who is the winner? 107.844.128. So the answer is 1931.728. Is there someone that called this for me? This one is wrong. No, I disagree. I disagree. So I'll give it to this. So Bukumi and these are the two winners. Oh, Bukumi and what? Bukumi and who else again? Emmanuel. So Emmanuel, let's do it like this. Let's do it like this. So I will just call you. Please, once I call you, you will have to pay 2,000 naira to the winner. Let me look for. Yeah, I got somebody. Damilola Badmos, can you speak? Hello,
Yes,
Damilola
boss.
Badmos, can you? Okay, so please, you have to please, because you did not tell me the answer, so you will transfer 2,000 naira to Emmanuel. Emmanuel,
No
Emmanuel,
problem. No test, sir.
please
Yes, I'm
Emmanuel,
here.
please can you send a message to Damilola Badmos now? Send me the screenshot that you sent it to him. Confirm it to me that you have sent it to him. Send him
I'm
either
lost.
you account.
What's going on?
Send him your account detail now. Emmanuel, send me a screenshot that you have sent it, and I want a confirmation that you have received the money. Emmanuel, can you do that now,
Okay.
please? So
Okay, no
Where should I
problem.
send it? On the chat?
you don't have his number, Abi. You see
Oh
now,
no,
you
I don't
people are
have
not
his number.
even networking is even poor. You guys are not networking with one another. Yeah, Mr.
Send it
Alabi.
to tutorial group.
Okay, send it to the tutorial group. Dami will pick it from there. Mr. Alabi, can you
All
hear me,
right,
sir?
sir.
Hello, Mr.
Sir,
Alabi,
I
can
can
you
hear
hear
you,
me?
sir. I can hear
So
you.
because you did not solve this question, so you have to send the sum of 2,000 naira to Bukumi now. Okay, sir. Yeah.
Okay, you said she said the account number.
Bukumi, send your account number to the group. Mr. Alabi will credit you with 2,000 naira. Thank you. So that is close. Let's move on. I hope you guys enjoyed this small meal I served you guys. We just do a quick drill, Let's be accurate now going forward with our questions. So I hope you guys know how to solve this question when next you see it now. I hope you guys know it. So let's move on. So today we are starting from equity. We are starting from equity valuation today. We are starting from equity valuations today. So let's discuss what is equity. The objective is I'm going to run through this equity. I will just run through all these things today. Then so when we meet on Wednesday, I have two options on Wednesday. There are a lot of questions we can solve, probably past questions, or let's just take past question on Wednesday. Wednesday is going to be the last class for investment before the exam. And tomorrow is our last class for QT. Please don't miss tomorrow's class on QT. It's going to be the final class tomorrow. So next week, we're only meeting on Monday and Wednesday so that we too can read our book. We never read. So we're meeting only Monday and Wednesday next week. All right. So let's quickly look at what this equity is all about. So equity is the residual interest in the asset of an entity after deducting all its liability. So once you have removed liability from your asset, whatever that is left is your equity. And this equity owner, they are basically the owner of the business, and their return is being paid in form of dividend. So their return is being paid in form of dividend. So now let's look at the valuation of equity. I will just be going straight to the point. No need for us to be speaking too many grammar. How do you value equity? So there are various school of thought on how equity can be valuated. We have the dividend approach proposed by Godon. So that Godon approach was criticized because he assumed that company does not pay tax and earning does not grow. And this has been proven not to be correct. That company actually pay tax and earning also grow. So Godon model was truncated. Also, Krogi too came up with their own too. Their own approach too was truncated. So the only approach that we now have for equity valuation is what is known as the discounted dividend. It's called discounted dividend model, DDM. So this is it. So this is what is known as the discounted DDM, the discounted dividend model. So that is the approach that is applicable for equity. So how do you calculate your valuation of equity now? It is E. This E is your earnings per share, 1 minus B. Please, whenever you see B in any corporate finance or investment and whatever formula, note that your B starts for your retention rate. Your B starts for your retention rate. KE is your cost of equity. R is your IRR or your yield. This R is IRR or yield. Okay, yield to maturity or whatever. R is your IRR or yield. Then R B is your retention rate. So this is the formula you use. But this formula is only applicable whenever you have a single growth method, when you are given a single growth. Okay, this formula is only applicable when single growth is given. You are given just only one growth rate is provided. But when you are given a multiple growth, when you are given a multiple growth, so when you are given a multiple growth, then this formula may not be applicable. There is a formula that you use when you are given a multiple growth. That was the one that Olowe taught us. So I think I solved this question for us on equity. Let me explain it again. This was the question that Dr. Ojogbo gave us in the class, which he did not solve. Please, if you are looking for a likely exam question, note this. Let me put it in red. Danger. This is your likely exam question. Dr. Ojogbo wrote it on the board and he left the class. He did not solve it for us. He wrote it on the board and he left the class. So please, I need your attention. I have already solved it for us before on this tutorial, but permit me to quickly go through it again. I will just go through the solution and teach us how we solved it. So look at the question. Your company paid a dividend of 80 kobo per share. Your company paid a dividend of 80 kobo per share. Directors of your company think that earnings and dividend grow at the rate of 8% per annum. So they think that earnings and dividend growth at the rate of 8% per annum for the next 10 years, after which it will increase to 10%, after which it will increase to 10%. So the EPS is currently 3.6 naira, while the investor rate of return is 15%. Calculate the market price per share. So the EPS is 3.6, while the investor rate of return, this investor rate of return is your IRR, is 15%. So let's solve it. So first of all, when you want to solve anything, the first thing you do is, first of all, bring out your vitals. When you go to the hospital for treatment, they will test all your vitals. So if the vitals are DO, DO means dividend at year 0. So 80 kobo per share is the dividend, DO. Then for 10 years, the growth rate for 10 years is 8%. So we have our G for 10 years, 8%. Then after 10 years, the growth rate will be 10%. That's it. Then EPS is 3.6 and our higher R is what? Is 15%. So if you apply the formula is this. I think this, Olowe wrote it for us. It confirmed that this formula is correct. So let's use the formula. It confirmed this formula to us in the class. Okay. But this T, sorry. I'm correct. So this is what I wrote this formula for us. I think +1. Okay. Yeah. So let me delete this one. That is not correct. Yeah. So this is the formula that we're going to use. This formula you see here. Okay. So note, whenever you see summation of something like this in the formula, what it implies is that summation means it's going to be for more than 1 year. So you have to apply your table in doing that. So let's do that now. So what we want to do first of all is this. Let us determine all this summation that we have here. This summation, let's determine the value for this summation, GO plus 1 plus G raised to power time T into divided by 1 plus KE raised to power T. let's do that first of all. So in doing that now, see, your dividend will grow for 10 years at the rate of what? 8%. They said that your dividend will grow for 10 years at the rate of what? 8%. So we need the present value of that dividend. The first thing you do is to calculate the present value of your 10 years dividend. So how do we calculate the present value of our 10 years dividend? You can see year 1 to year 10. We have them here. At year 0, our dividend was 0.8 Abi. Now, if your dividend will grow by 8%, that means what you are going to have will be 1 plus 8%. That will give you 1.08. So if you multiply 1.08 by this 8%, at the end of year 1, your dividend is 0.8. Now, it is this 0.8 that you have at the end of year 1 that will become your opening balance at the beginning of year 2. You can see, same thing, so you multiply by 1.8. Then 0.93 you have at the end of year 3 is going to be your opening balance at the end of year 3. Sorry, this at the end of year 2 will be the opening balance at the end of year 3. So you continue like that up to 10 years. So this is our dividend. Whatever you have here now, this is the value of the dividend for 10 years. This is the first thing you do. You need to calculate each of the dividend for 10 years. Now, if this is your dividend for 10 years, then you now apply your DCF. The DCF is at 15%, right? So do your normal DCF 1, 2, 3, 4, 5 at 15%. Then you multiply it by this value of dividend, you get your PV. Okay, so if you sum up all this PV now, you have 5.75661. If you sum up all the PV, you get 5.7561. So that's it. So Bukumi Badmus, sorry, is it clear now? You messaged me that you need clarity. Is that 5.75756? Is it clear now? Yeah, I deliberately
Yes,
had to repeat it. I deliberately repeat it because of you, since you flagged it. Okay, so thank you for that clarity.
So you don't thank me. You are saying thank you for that.
Okay, so let's continue. Let's continue with this now. All right. So we have this like this. So this is 5.7671. So that's for the first. That's for this left hand side. See, the formula is into two. We have the left and the right hand side. So for the left hand side, so you can see that this is what we have for the left hand side. So 0.8, 1.08 divided by 1 plus 0.15 times t, which is 10 years. So everything we have on this left hand side, that's 5.7561. 5.7561. So they can see everything on the left hand side. So that's 5.7561. Okay, that's what we have here. Now, so doing your right hand side is not a problem. Doing your right hand side, let me do it properly for you. Let me do it properly. So this plus is here. This plus is here. So this right hand side is not a problem because this dn plus 1 that is on this formula, this dn plus 1, you calculate it at once. DN mean the dividend at that year 11 is what you are calculating. Dividend at that year 11. So you can see what the way we do it here. So for you to know dividend at year 11, for you to know the dividend at year 11, you first of all need to calculate the dividend at year 10. So the dividend at year 10 is 0.8 into 1.0 raised to power 10, right? That gives us 1.721. Then this one you are seeing here is that plus 1. This plus 1 you have in this formula. This plus 1, you see. This DN now is dividend at year 10, which we need to convert to year 11, right? So this plus 1 you see in this formula is what we applied here by saying, okay, multiply it by 1 times 1.1. So that means our dividend at year 11 is going to be 1.899. So when you have 1.899, then you divide it, you apply the remaining formula, which is your KE minus growth 2 into 1 times 1 plus KE into N. So once you apply it, follow that way. So your price is about 15 naira. So this was the question that Dr. Ojobo wrote, which he did not solve for us. So please watch out for this question. No? That's Dr. Ojobo's question, which he did not solve for us. Okay. All right. So I want to, so that's for this now. So please, hello. Sorry, I'm with you. Question?
Yes, sorry. So please go down to year 10 on the table.
On the table.
Yes, on that table. Can you go down to your 10?
Yeah, I'm there.
So yeah, when I did mine, instead of doing instead of doing I don't know, but I'm thinking if we use this 1.73, that's the one that has already been done at 10 years, then we now,
Mm.
since they said it's after year 10, when the dividend has started to grow at 10%.
See,
So if
this
we take that
1.73, it's still the same thing,
and
bro.
apply
See, it's
1.4,
still the same thing. See, 1.73 is still the same. It is me that is trying to do over syllabus for you. You can see it's still the same 1.73 that we have here. Can you see it?
okay.
Can you see?
Okay.
I was just trying to show you. You can just say this is going to be your year 11. Now, I made a do over syllabus for you guys, so it's still the same thing. This is your year 11. Simple. Okay? You can just do it like instead of doing all this calculation I've done here. Okay, so let's leave. Let's leave. So that's for bond valuation now. What do you need to know under bond valuation? Convexity of the bond. So these are what you need to know under bond valuation. Number one is how to calculate the pricing of the bond, redeemable bond and irredeemable bond. Then how to calculate the yield to maturity. Okay. Now, please let me clarify something to everybody now. These are the three. I wanted to create like 1 hour time. No, I need the private time 1 hour, maybe after this class. I want to list out all the formula we have in our investment for us so that you can practice those formulas. Okay, I want to list out all the formulas. So if the questions come and say calculate yield to maturity, if a questions come and the question state calculate yield to maturity, so what you are to do is to calculate your IRR. Okay, if the questions come and say calculate, hello, sorry, who is that? Someone is speaking. Oh, sorry, someone is speaking. Oh, okay, I think it was a mistake. So if the questions come and the question state that calculate yield to maturity, note that what they want you to do is this, is to calculate your IRR. Please don't miss that. If a question come and they say calculate information, you have to calculate your IRR. Then if your questions come and the question says calculate your current yield, your current yield is equal to your coupon divided by the PO, price of the bond, or the fair value. Okay, or you call it PO. PO. That's that's how to calculate your current yield. So this is your current yield, your coupon divided by your pricing. That's your current yield. Then if they say you should calculate your approximate yield to maturity, approximate yield to maturity is equal to AYM. So this was where Dr. Ojogo made a mistake. Sorry that I'm saying my lecturer made a mistake, but it was a mistake which we have been able to correct here. Sorry, my man to be busy in 2 ways. I hope you understand the second one. So we have approximate yield to maturity C. That's your coupon. Okay, into what? Your I think this is going to be F minus P, right? F minus PO, like this, divided by 10. Divided by what? 10. Then you will now say everything now. Everything divided by what? You divide everything by what? F plus PO. F plus P. F plus P divided by 2. So if you go through this material, we have actually solved question relating to this. So this is the formula for approximate yield to maturity, which we have solved before. We have solved it. So we have the bond duration. Please go through our previous material. We have solved questions on bond duration. We have yield to call. We have solved yield to call. We have the convexity of the bond. So we have also solved everything. So this junction now, do we have any question on bond? Because I want to move on to risk and return our portfolio. Any question on bond, please? Let me hold on for you guys to speak. Hmm? Do we have any questions on bond?
Kazima, have you done the
I'm
convexity?
sorry. Okay.
I
You
thought you
mean
wanted to do
convexity of? Haven't we done convexity? I think we've done it now. Abi?
Yeah, I thought you wanted to revise it now.
You mean I should revise the convexity of the bond again, Abi?
Yes, please.
Okay. I think it should still be somewhere down. Let's continue. Let's continue with this. I might revise it. It should be down. Okay, let's move on to. I will take it again. No, I got you covered, bro. Don't worry. I'll take
Please,
it again.
sorry, Kazim, can you go up? I want to check something, please. You said
Up like
this.
this.
Yes. This formula here. Sorry, I don't get you. You said we've already solved for the
See,
for
this
the
1.7, this 1.7, whatever, yeah, it's the same
okay.
thing you have here. Hmm? Do you
Yes.
get it? Yeah, it's the same. So
Yes.
you can ignore this story here and just use that one directly. Okay. So let's move on to okay. I am recording. Yeah. So let's quickly. So today I want to finish risk and return analysis. I also want to finish portfolio today. Then the what's it called? The capital line, this indifference curve, the efficient frontier. I want to also discuss and finish it today. Then CAPIM too. I want to treat CAPIM. I can't finish CAPIM today, but anywhere we stop, we'll just bless it like that. Then there is a question too that Olowe gave us a question in class yesterday on this three Jensen and stuff that he couldn't solve for us. So I want to also solve that question today. In case you have not eaten, just get your lunch and eat so. Because this is going to be a long day for us. Okay. Let's start with the risk and return analysis now. So when it's come to investment planning, the most important thing is for you to be able to strike a balance between your risk and return, right? For you to be able to strike a balance between risk and return, because normally they say that the higher the risk, the higher the what, the return. So you need to be able to strike a balance. For example, let me try and form like Professor Lowe. In case he asks us to draw a graph analyzing risk and return. Let me see if I can. So suppose you have a graph like this. Okay, so your return is here and your risk is here. Your risk is here. So the gap for the risk and return is always upward sloping like this. Start from zero. It may not be direct, it may still bend or somehow, because when the return is going up, most likely your risk will also be going up. So that's just how it looks like. It may not be directly straight. It can be something like this. What is it? There are some security that the returns can go up for like 10%, and the risk will only increase by 2%. It depends. So it's not necessarily that it's a straight line. Just do something that is not straight. It can be going up. Those that do crypto, they understand what I'm saying. That's how they are, whatever, keep moving every day. It keep moving like that, dancing. So that's what they check every day. Those that do crypto. Okay. All right, let's move on. So that's just the relationship between risk and return. So in a nutshell, the higher the risk, the higher your return. So we know what is the risk. Risk is the potential loss in the value of your assets, right? Risk is the potential loss in the value of an asset due to something that probably are not within your control. So it is basically the vulnerability of your asset to various factors. And there are two types of risk. First one is, please, always keep mentioning this. This is area to note. They can ask us to differentiate between systematic risk and unsystematic risk in the exam. Because you keep mentioning it every time. If you notice in the class, you keep explaining it again. The systematic risk and unsystematic risk. So when we say I've explained this one so tired. Let me just explain it probably for the last time today. Systematic risk are those risks that are market risks. They are not within our control. Examples are your economic recession, political stability, changes in all these ones are systematic risk. So you cannot diversify your systematic risk. So you only use CAPIM for systematic risk. So this CAPIM is applicable to systematic risk. Why? On systematic risk, there are those risks that are within your control. E.g., if you have a poor management, poor accountant, poor CFO, poor regulatory compliance, that's your unsystematic risk. So this unsystematic risk can be diversified through portfolio. This one can be you can use your portfolio to diversify your unsystematic risk. So how do you now measure risk? So there are various ways of measuring risk. We have the standard deviation. So standard deviation just measure the spread, the spread of your risk, right? So the higher the standard deviation, the higher the risk. So if your standard deviation is high, that shows that your risk is also very high. So what we use under portfolio is standard deviation. But when we come to CAPIM, what we use under CAPIM is known as what? Beta. So what we use under CAPIM is known as what? Beta. So beta measure the sensitivity of an asset return to what is happening in the market. So we compare the changes. Sensitivity simply means how something reacts to something. That's sensitivity, how you react to something. So that is what sensitivity means. So if your beta is greater than 1, it indicated that you have a higher security risk than the market. While if your beta is less than 1, it shows that at least your security is still better when compared to what is applicable in the market. So beta is usually used under CAPIM, while standard deviation is used under portfolio diversification. Okay, this is just for our understanding, right? So these are also types of returns that we have. Returns. So what is return? Return basically is gain or whatever we are deriving from our investment. Sorry, hope I'm not too fast or am I too slow so I can adjust my pace. I need comment for 1 or 2. Am I too fast or too slow so I can adjust my pace?
You're
So yeah,
okay,
someone
sir.
should speak. Okay, Abby. Thank you. So I've explained returns. So let's move on to types of return. God, who is G? This G is let me meet the person. Somebody G or something is on mute. Grace, I'm muting you. Thank God. Thank you. I've muted yourself because of the noise. I have a lot of strange name here today. There is one Crystal Gaming Tech. Hello, Crystal Gaming Tech. Can you speak? Let's hear your voice. I'll be taking this break like this so that Mr. can catch my breath. Crystal Gaming Tech.
It's gospel. It's gospel.
Why do you not use Crystal Gaming Tech? You want to confuse us?
My work email.
Okay, but you should show your name now. Okay.
Mistake. It was a mistake.
Who is FTT? Are we doing fund transfer here? FTT, who are you?
It's for me, it's for me. It's for me.
So what's the relationship between your name and FTT?
You for me, JTF. FTT. For me, liar. For me, liar, Temitope. That's my name. Thank you.
Before you join, look at there are some people here called Two Kidney. They've shown me Shege your absence. I will gist you after. I'm sure you know who those 2 kidneys are.
Coffee. Coffee.
Two of them are together. They've shown me some Shege before we start. Who else again? I'm looking for all those unknown names. 2AO, who are you? Speak. I've been saying this 2AO for quite a while. Who is 2AO?
Ajibike. Is Ajibike? Ajibike.
Okay, just use your name now. You're confusing us now.
So I've been using this since now.
I know. I've always been wondering. You use your real name. Anyway, nothing's spoiled. Let's move on. Who else again do I want to call out to? These 2 kidney, I'm still worried that they are not. Okay. I've taken enough break. Let's continue. So intermittently, I'll be taking this break to catch my breath as well. Okay. These are the 4 types of returns that we have. Okay. 4 types of return. So we have what is known as the expected return. So this is the return that you are expecting based on the historical data of the company. What you are expecting based on the historical data. Actual return is the actual money that you realize is your actual return. The one they pay you go is actual return. Then when we say nominal return, this one is a return before adjusting for inflation. Okay, why real return is a return after adjusting for inflation. So they used to say that your 1 plus RM nominal return is equal to, let's use RN. RN is nominal. 1 plus RN is equal to 1 plus real rates into 1 plus inflation like this. So this is the relationship between your real and nominal. So the first one is a nominal, the second one is your real, and you adjust it for inflation. So so that's just it. So if you can also apply this in GDP too. If you want to apply a GDP, you have your nominal GDP. GDP is equal to your real GDP. Your real GDP multiplied by inflation, like this. So if you want to calculate your real GDP will now be your nominal GDP divided by inflation, or they call it GDP deflator, or whichever they want grammar they use. Inflation or GDP deflator, whichever one. Anyway, I'm digressing to what's it called? To what we know, macroeconomics. So Solomon Nobel, so I'm trying to teach you. I'm not an expert, you're not the expert here. So how do you measure returns now? So there are 3 ways of measuring returns. The first one is the arithmetic. This is one is simple interest, or use your compound interest, or you use IRR. These are the various ways of measuring returns. So let's move on. Now, we have the risk and return trade-off. So this is basically talking about how you manage your risk. We said that the higher the risk, the higher the return, and the lower the risk, the lower the return. So how you're able to manage the relationship between your risk and return is one of the major factors that needs to be considered. Okay. Now, so these are the ways of managing your risk and return. The first one is through your portfolio diversification, which we're going to look in detail shortly. Then we have the capital asset pricing model, which we will also look at in details. Okay. And the third one is Sharpe ratio. This Sharpe ratio, let me remove it. We are not taught this, so there's no need to include it here. We are not taught the Sharpe ratio. Let me remove it. Okay, so now let's look at this scenario.
I think Olowe mentioned yesterday.
Did he?
Olowe mentioned yesterday.
Did he?
Those 3, yes, those 3
Yes,
measurement I gave yesterday.
Yeah, he mentioned it yesterday, but he called it Sharpe Mayor instead of ratio. It's the same thing. He called it Sharpe Mayor instead of ratio. It's the same thing.
Sharpe measure.
Yeah, that was what he called it yesterday, but it's the same thing.
Okay. So it's basically measure the performance of an investment when compared to a risk-free asset. Okay, we are comparing what your own is doing versus the risk-free investment. That's what is measured. So let's look at this analysis now. We said that the higher the standard deviation, the higher the risk, and the lower the deviation, the lower the risk. So suppose an investment is considered to stock A and B. Stock A have an expected return of 8%, standard deviation of 10%, beta of 0.9. Then stock B have expected return of 12%, standard deviation of 20%, and beta of 1.5. So if you look at these 2 investments now, we can confidently state that the risky investment is B. So because investment B has a higher risk, you can see that the return is also higher when compared to investment A. So the investor needs to decide on whichever ones he wants to go for. There are some investors that are risk averse. Risk averse are someone like me that I don't want to take risk at all. So I would rather go for a risk-free investment. But some investors, they love risk. They enjoy taking risks. So those ones, know that they always go for a risky one, such as MMM. Okay. So that's for that. Now, approach to security analysis. There are two approaches. We have the fundamental analysis and technical analysis. So we've also explained this on, I've explained this on millions of times. I said that your fundamental analysis is the one that focuses on your intrinsic value. It focuses on the value within the company. Then technical analysis focus more on the external, that is the market, and use that one to predict. So that's for that. So now moving on to portfolio responsible now. So what is portfolio? So portfolio is any investment with one or more assets. So when you have combination of two or more assets, that's what is known as what? Portfolio. So when we now say portfolio analysis, so this is a process of determining the risk and return of the portfolio so that we can arrive at the most efficient portfolio. So the process of determining the risk and return of a portfolio to enable us to arrive at the most efficient portfolio is what that we know as portfolio analysis. So these are the various total portfolio risks. So total portfolio risk is a combination of the risk of all your assets. When you combine all assets together, both the systematic and unsystematic, that's your total portfolio risk. But note that this systematic risk is within the scope of CAPIM. We don't use portfolio for it. We don't use diversification, but it is only us systematic risk that we can eliminate through diversification. So whenever you want to calculate your portfolio, please note this. You must know how to calculate your standard deviation and variance. Is very important. So if you will discuss this a lot last time, I even solved past question on standard deviation and variance for us last class. So if you are not there, maybe the question will still get there. I can quickly revise it for us because something is telling me that we cannot escape this in the exam. How to calculate variance and standard deviation. So without us looking at our book, can you guys tell me formula for two variance security? Anybody? Please, there is no money here. We're not giving out money. Let's play. Let's relax more. So what's the formula? What's the variance for two asset security? Oh yeah, someone should tell me. Oh yeah, who want to go? Oh yeah, two asset security, A and B. So
Should I
let me do
go?
it. Oh yeah, let's go. Yeah.
Sigma
Oh
square
yeah.
is equal to W square A.
Okay, sigma square A.
Sigma
okay.
square A.
Okay,
Plus,
this is for A. Plus.
Yes, plus W square B.
W square B.
B.
Okay.
Sigma square B.
Okay.
Plus 2WA.
Plus what? Plus
2WA WB.
2WA
WB.
WB. Okay.
RAB.
Then R is your coefficient. Okay. RAB
Sigma.
RAB. The standard deviation. Sigma A.
Sigma B.
Sigma B. Please, if you don't know this formula for two asset security, please go and learn it. Okay? Because all always said we should not go beyond two assets. If you don't know it, please go and learn it. So there's also correlation. Then for correlation now, it's usually between the range of 1, -1, and +1. So if your correlation is +1, that means the assets are positively correlated. So for a positively correlated asset, it is not advisable. That means that both assets are moving in the same direction. That's for positive. So it is not advisable that you invest in a positively correlated asset, because what it means is that the two assets are moving in the same direction. That is what positively correlated asset is all about. So the two assets are moving in the same direction. That's the positively correlated asset. All right. Then the second one is negatively correlated asset. So for negatively correlated asset, what it implies is that the two assets are moving in inverse direction. If one is going up, the other one is coming down. So for negative correlation assets, it is not advisable for you to have such assets in your portfolio. That is, both of them are sleeping on the same side of the bed. It's not advisable to have such assets in your portfolio. Okay. Then the third one is zero correlation. That one means it is either here or there. So you don't need to, you use your own church or mosque mind to decide. So, all right, let's look at the diversification. Diversification involves spreading your investment across various ways to reduce your unsystematic risk. The key word is unsystematic risk. Okay, the key word is your unsystematic risk. So diversification can help you to reduce your total risk. So look at this now. How do you now calculate the expected return of a portfolio? So the expected return of a portfolio is the weighted average of the expected return of the individual asset. So before you can determine the expected return of a portfolio, you must first determine the return of the individual asset. Then you will now calculate the weighted average of that. So hopefully we should be able to, okay. I think the next thing we are discussing now is just that. So look at this question that Dr. Hammer gave us in the class, which we solved. He said, assuming there is a portfolio comprised of First Bank share and NBC share, expected return of First Bank is 10%, while expected return from NBC is 50%. The amount of investment is 10 million, 6 million is for First Bank, and 4 million is NBC. So the right return of the portfolio. So what we just do is the investment is in 60-40, 60 to First Bank, 40 to NBC. So expected return is weight of A, 60%, multiplied by return of A, which is 0.1, plus weight of B, 40%, multiplied by return of B. So we got this 12%. Okay. Now I now have a question that I want to solve for us. When I was doing my own revision, I came across this question. So let me take my breath. Somebody should quickly help us read. Somebody should read these questions for us.
You have 1 million naira.
Carry on, carry on.
You have 1 million naira to invest in stock A and B. The following information is given for the two stock. Stock A, current price 40 naira, expected price in 1 year 48 naira, expected dividend 0 naira. For stock B, current price 50 naira, expected price in 1 year 63 naira, expected dividends is 2 naira. You have decided to invest 750,000 on stock A and 250,000 on stock B. Calculate the expected return on your portfolio. B. Now assume you desire an expected return of 28% on your portfolio. How would you invest your 1 million naira? C. Alternatively, assume you desire a return of 36%. How much should you invest in each stock?
Okay, so I will solve A and B. I will leave C for you guys to solve. So solution. Calculate the expected return on the portfolio. So let's look at stock A. So how do you calculate your return on portfolio? Olowe gave us the formula RT minus RN. I mean RT minus RN plus DO divided by RN. I don't know if you guys remember this formula. Okay, RN. So this RT, your RT is the current price. I mean, what is it called? The future price of the security. For A now, the future price is 48. Then the current price is your RN, that's 40, plus whatever dividend they declare is 0, divided by RN, which is what? 40, by your current price, 40. So what do you have if you do this now, please? What do you have? So this will be 48 minus 40 divided by 40. This is 20%. Sorry, guys, are we together? Hello, are we together?
Yes, we are together.
Is it clear? Do you remember this formula that Olawe gave us in class? Do you remember?
Yes. Yeah, I did not
Thank
remember,
you.
but we are together. We are together, Sha.
I don't want us to be together, Sha. I want you to remember. If you cannot remember, that means you have not maybe done your revision, but it is fine. Let's move on. Stock B. So let's calculate the expected return on stock B. So we'll follow the same formula. The current price is, the future price is 63 minus current price is 50 plus dividend of 2. Then you divide it by what? By 50. So what is it? What is it? What do we have? What's the answer? 63 minus 50 plus 2 divided by 50. I got 30%. Am I correct? Hello, am I correct? I got 30%.
Yes.
Okay. Yeah. So that's the A. Then B part. That's it. B part now says that. B part now says, now assume you desire an expected return of 28% of your portfolio. How would you invest your 1 million? Now let's say that expected return. So this thing, why is it changing? So we desire an expected return of 28%. So how are we going to invest the formula for the expected return on portfolio is equal to weight of A, return of A, plus weight of B, return of B. Do you guys understand this formula? Do you guys understand this formula of expected return? Hello, do you understand this formula? Please speak now. I don't want to be the only one solving it. Do we understand this formula?
Yes.
Yeah.
Okay. Thank you. So now they now give us that expected return is 28, meaning what we are expecting is 28. So it's going to be 0.28, Abby. So now we have to do some mathematics here. So what is let's use A as our main variable. What's our weight of A? They say you have 1 million to invest the following. So you are there to invest 750 on stock A and 250 on stock B. 750 on stock A. So that means the weight of A. So if you say 750 on over 1 million, that should be 75%, Abby. So a weight of A is 75%.
Sorry, Mr. Kazim. Sorry, apology. Yes, here now, we are not going to use the previous weight that was given. We can say the weight of asset A is X. Why the weight of the other will not be X minus 1?
Boss, we'll get there. We'll get there, sir. Don't worry. They say we want to calculate the new weight. That is what we want to do. We want to calculate the new weight. We want to calculate the new weight. Just follow me, sir. Follow me. So this is 0.75, Abby. Multiply it by what is the current return we are getting from A? What is the current return we are getting from A? The current return we are getting from A is 30. It's 20%, Abby. This times 0.2, Abby. Now, you will now say B, weight of B. What is going to be the weight of B? Now, what's going to be the weight of B? So remember that your weight of B is equal to 1 minus WA. Do you get it? 1 minus weight of A is your weight of B. Is that clear to everybody? Hello? Hello?
Yes.
Hello, Mr. Kazim. Hello, Mr. Kazim. Sorry for this. The weight of B now will not be 0.25. And we have already known the return of B. So there's no way we can solve this question, except we say the weight of A, let's say it's X. Then the weight of B will now be X minus 1. Since we have known their return, then we now look for what X is.
Okay.
We now make the X the subject of the formula.
I understand you, sir. Okay, I understand you, sir. But just follow the way I'm solving it, then we'll arrive at the conclusion. Okay. Before I can solve it like this, I have also done my research. Okay, before I can come here to be teaching or solving this thing. Let's just arrive at it. We can prove whatever we get. Okay. So return of B is equal to 1 minus RA. Do you understand this formula, everybody? Do we understand this formula that weight of B is equal to 1 minus weight of A, sorry. Then return of B is equal to 1 minus return of what? A. Now we want to calculate a new weight that if we combine the returns of this new weight, it will give us 0.28 as our expected return. So what you will simply do is that we are looking for, what are we looking for? We are looking for weight of what? B. But we can easily calculate the weight of A. Okay, we can easily calculate the weight of A. So how? We will just say, we can easily calculate the weight of A. So we'll just say 1 minus WA here multiplied by what is the return of B? Return of B is 0.3. So let's quickly solve this formula. Let's solve this like this. Let's solve this like this. So this is 0.28 is equal to what? So this 0.75 times 0.2. 0.75 times 0.2. So the answer is 0.15. Okay. So 0.15 Abi. Plus times minus, that's plus 1. Okay. That's minus weight of, sorry. Let's expand this 0.3. This one will be 0.3. It will be plus 0.3 Abi minus 0.3A. 3WA like this. So let's solve this now. So if we want to solve this now, it will be 0.28 minus 0.15 minus 0.3. Okay. Minus 0.3 is equal to minus 0.3 weight of A. So what do we have? 0.28 minus 0.15 minus 0.3. So this gives me minus 0.17 is equal to minus 0.3 weight of A. So if I want to calculate weight of A, so what's going to be the weight of A? What's going to be the weight of A? The weight of A is going to be 0.17 divided by 0.3. So what's the answer, please? So this would be 0.17 divided by 0.3. That gives me about 57% or thereabouts. So if weight of A is 57%, weight of B will be about 47%. Mr. Alabi, is this different from how you solved your own or what you get as your answer? Mr. Alabi, can you confirm?
But not 57.
I've not solved it. But I've not solved it. I'm just thinking that is how it should be. Except I've not solved it.
Okay. Okay. Return of. Hold on. What's this sound? Noise. Okay. Hello. This is the solution to the question. Oh, nice. So sorry, where is the noise coming from? This is the solution to the question, right? This is actually an I can question. So let's look at it now. I think my calculation is incorrect. So look at these questions now. We have weight of A, RA plus weight of B, RB, right? So 28 is what we need. Okay. I shouldn't have used this weight of A. It would have been, this thing disappeared now. It should have been weight of A. Okay, let me be correct. This would have been weight of A. Weight of A into 0.2. Yeah. So are you following? Weight of A into 0.2 plus weight of B is equal to 1 minus weight of A. I think we got that one right. 1 minus weight of A, yes, into 0.3. Yeah, this is it. So please, guys, watch this. So if you do it like this, and I think weight of A, if I redo it with this formula, weight 0.2, this is 0.2 0.2 weight of A. Okay, so if I do it with this formula, the weight of A should be 80%. Yeah, the weight of A will be about 80%. You can work it out mathematically. It will be about 80%. Then weight of B is about 20%. So if you work it out like this, so this was 0.28 is equal to 0.2 weight of A plus 0.3 minus 0.3 weight of A. So let's substitute. So you bring this one will come here 0.28 minus 0.3 is equal to this plus this minus this. So I just want to show it. I want to solve it for us completely so I don't just leave the answer directly. So that's 0.28 minus 0.3. This is 0.02 minus 0.02 is equal to 0.2 minus 0.3. This is minus 0.1 minus 0.1 weight of A. So just say 0.02 divided by 0.1. So that's about, no, 0.02 divided by 0.1. That's about 20% for weight of A. Weight of A is 20. Weight of B is 80. Yeah. So that's it. That's the answer. Weight of A is 20, then weight of B is 80. Sorry, who does not understand this solution, please? So I can repeat it. That we are done with it. Who doesn't understand this solution, please?
I don't understand though.
Yeah, because I think I saw this thing in the past question. That is the reason why I brought it up from the ICANN material, because I'm also using ICANN SFM materials to prepare for this investment. Because only go on. Okay, let me quickly do the justification. Mr. Alabi, please quickly resolve it, sir. Let me know if you get something different from this, sir. Okay, use your own formula to solve it.
See, no, it's correct. You know, with the way you now solve it, it's the same. Whereby we can just say the weight of A is X, then the weight of B will now be X minus 1, which is the same way you solve. It's the same. You know, when we say this weight of A is X, yes, it's the same now. When we say this weight of A is X, then this will now be 1 minus X. We'll now make weight of A as the subject of the formula, which you got as 80. Then which you got as a 20. The other will now be 1 minus that 20 gives 80. It's the same to 20 and 80 is correct.
So the final answer is correct, Abi?
It's correct. It's correct, sir. It's correct.
Thank you. Thank you, boss. Thank you, boss. You know, you are not supposed to be writing MSc with us, you're supposed to be writing PhD, sir. With us. Because your level seems to be higher. You're supposed to be in PhD class. So okay. Okay. For those that doesn't understand it, oh my god, we still have a lot to cover. Let me explain it again now. So expected return of the portfolio. If you are giving a targeted return, here now, we are giving a targeted return of 28% on our portfolio. Our targeted return is 28%. So if you are given that, so that means your ERP is 28%. So you must make one of these two, weight of A or weight of B. You must make one of them your subject of the formula. In this case now, I make my weight of A as my subject of the formula. So weight of A, I have a return of 20%. Plus, my weight of B is going to be 1 minus weight of A. That's going to be my weight of B, which is what I have here. Okay, multiply it by the return on B, 0.3. So by the time you solve it mathematically, you should get weight of A as 20. Then if weight of A is 20, then weight of B will be 80. Okay, so that is what we've done here. All right, C part. Alternatively, assuming you desire a return of 36%, how much will you invest in this stock? Can you guys try this one in 1 minute or 2 minutes?
Casey, please. Sorry, excuse me, Casey. Your weight of A, is it not 2%? Is that not 2 instead of 20?
It's 80 now. It's 80, multiply by 100%. Multiply by 100. 0.1 divided, 0.02 divided by 0.1 times 100. That will give you 20. That's right. Divided by 0.1 times 100.
Okay, thank you.
Okay, now in 2 minutes, let me just stretch my leg too. I've been sitting here for almost 2 hours now. In 2 minutes, can you guys quickly give me the weight of A and weight of B? Assuming it's 36% we are working towards. Thank God I have the solution is not on the screen now. Can you give me the weight of A and weight of B? Suppose we are working towards 36% return. Yeah. Has anyone finished? What's the answer? Assuming we are working towards 36%, what is the weight of A and weight of B? Assuming we are working towards 36% return. No price, so don't ask me. Those that want price, congrats to them.
Share the screen. We don't see the screen.
36%, Timoso. I did not want you to see it so that you will not copy. Just tell me that 36%. What is the weight of A and weight of B? No price. What is it? Glory, check your audio. Check your audio. Your audio is very bad. Can you check your audio? Is very bad.
Sir?
Yeah. Oh, it's too noisy. Okay, who else again want to speak?
Weight of A 60, then B 40.
Okay, I will assume you are correct. Let's move on. Let's move on. Let's move on. So I assume you are correct. So, but I don't know. Let's move on. So, other things to discuss: actual return on portfolio. So this one's so I don't think they will ask this. Dr. Amma taught us this one in class that if you are giving this kind of stuff, how will you know your actual return on portfolio? It is very simple. Just you subtract your new value from the old value and divide it by the old value. So here now, our actual return was 50. How did we get this 0? Because there was no, because here 0 is the base value. How did we get this 50%? 50% is this 1.5 minus 1 divided by 1. That's 50%. So that's how we got it. So you can, so how did you get 20% here? 1.8 minus 1.5 divided by base value 1.5 times 100. That's 20%. So you follow the same method like that. So that's what we did. Dr. Amma taught us this. So the variance of a security, we've done that also. So I believe that we all should be able to calculate two security variance now. I believe we all sorry. We all should be able to calculate the variance for two securities. So which is the formula that we did the other time. Okay, so let me skip. So these three assets, don't waste your time on it. So don't go and be working on three assets. Olowe already told us that it's not going to test three asset variance. So don't go and waste your time on three asset security. He said he's not going to test question on three. He will stop at 2. So how to know the number of covariance? So it's simply the number of covariance divided by n minus 1 divided by 2. This is how to know the number of covariance. But like I said, don't go beyond 2 security. Don't go and waste your time on. So if you are to calculate the number of covariance for the following assets, so you can just use this one to practice, but I don't think anybody will ask us to do this in the exam. Your number of variance is equal to the number of your security. Then it is the covariance that you have to calculate n into n minus 1 divided by 2. So, but just know it for knowledge sake, but I don't think anybody will ask us this in the exam. Okay. For knowledge sake, you can know it, how to calculate it. So this one still is the same. All right, let's continue now. Mr. Conversity, Emmanuel. Emmanuel, are you still on this call? Emmanuel, are you still on this call? He's not on this call. Okay, guys, just give me like 3 minutes. Let me quickly sort out something. Please give me like 3 minutes. I'll be back. Yeah. Hello, guys. I'm back. Oh, can everyone hear me, please? Hello, can you guys hear me?
Yes, we can.
Yes.
We can hear
Oh,
you.
okay. I am back. Hey, why is my laptop not charging? So it's a shake. Okay, it's charging now. Before you guys will think I don't have light like some people. Okay. I want to look for trouble. So this is the aspect of the bond valuation that Professor Lowe taught us, which includes convexity and the rest. I don't know. The person that asked me about convexity, Emmanuel, are you on this call, Emma? Can you speak if you're on this call? Emmanuel, you are now. Please speak, speak, speak. Okay, let's just move on. Let's move on. So it was the one that asked about. So this is the aspect that, in case you want to know which aspect of the bond valuation or lower taught and which one the Jobo taught, this is a good material. So all what we have discussed previously on bond valuation, they were taught by Dr. Ojobo, right? Then the one we are discussing now on bond, these are the area that Professor Olowe taught us. So let's just be mindful of that, right? So he taught us about the time structures and the time structures of interest rate. We try to establish the relationship between the time structures and how the interest rates are determined. And the main thing is that your interest rate or the time structure usually depicted by what is known as a yield curve. So this yield curve basically shows the relationship between the maturity time and the interest rate. So there are three different type of yield curve that you should know. The first one is this upward sloping. So normal, your yield curve supposed to be upward sloping. What it means is that if the duration of your investment is high, then your interest rate too is expected to be high. Let me show you that graphically. If the duration of your investment is high, then your interest rate too should be high to compensate you for the time. So this is how, let's assume our duration is here our interest rate is here. So it's supposed to be like this, upward sloping. Okay, that is if you have invested for 5 years, your interest rate for 5 years will be higher for someone that only invested for 3 years. So because you are keeping your money longer while the other person is keeping his or her money shorter. So that's the meaning of upward. So this is under normal circumstances now. Your yield curve supposed to be upward sloping. That is why they call it normal yield curve. So if your interest rate is high, then your yield or your duration, if your duration is high, your yield or your interest rates too should be high. That is the meaning of upward sloping. Then the second one is known as the downward sloping. So for the downward sloping now, so for the one that we call the downward sloping, so this downward sloping is known as the inverted yield. So this downward sloping is usually the downward sloping is always applicable during recession. Okay, this downward sloping is only applicable during recession because that is when they just want quick money from you. So under this downward sloping now, your interest rate is always shorter for a short time. It's always higher for a short time period because they want quick money from you. That is why your interest rate will be always very high for a short time period. So note that this downward sloping is always applicable only when a company is having a recession and they need quick monies to quickly get out of the recession. Then flat yield curve. This one does not show any difference between upward and downward. It's still like same. There is no difference between the short and long term investment. So, but note that under normal circumstances, your yield curve should be upward sloping. Then downward sloping is only during recession. So, what are the factors that influence the time structure? We have the expectation theory. So, under this expectation theory, a rational investor expects a higher return for a long-term investment. A rational investors expect a higher return for a long-term investment. That is why here your forward rate is always almost the same as your spot rate. I believe I've been able to explain the meaning of a forward rate, right? In my previous class, I explained what is forward rate and what is your expected spot rate. So I use somebody's wedding as an example. I think Toby or thereabouts. Okay, let me just relax. Let me have my breath. Let me take my breath. Can somebody quickly explain forward rate for us? Anybody? Let me know if you guys understand the forward rate. Can somebody quickly explain forward rate quickly? Can somebody quickly explain forward rate quickly? Oh yeah, now don't fall my hand though, guys.
Kazim,
Can
please
someone?
explain it again.
Okay, I believe one person should be able to explain it. If no one can explain it, I will explain it again. But I just want somebody to speak. Who else want to try? Somebody should try now. I have all my big guys here. What is a forward rate? Someone should explain it. Who want to
Okay.
speak now?
Kazim,
Is the interest that is expected to rule the market in future, but is determined now, determined today.
The interest rate that will be applicable for a future transaction, which is determined today. Okay, who said that I should explain again? Can that person speak? Who said I should explain again? I want to use that person as a case study. Okay, Toby, you said I should explain it again now. It was even you that I used. Maybe you are out in soon and you are already sleeping that time. I said, Azumi, guys, I didn't post a picture yesterday. We have a new couple in town, Toby and Prof. Alabi. I did not post their picture yesterday. I don't know what entered my head. I did not post it. So let's assume that this wedding now will take place in March 2024, 2025, after our project defense. They will just rush and do the wedding after our project defense. It will take place in March 2025. Now, the clothes that they will use for this wedding, they want to import that clothes from Dubai. So they will be needing about 1,000 yards of a special fabrics, which will be delivered from Dubai. Now, Toby does not, our Professor Alabi does not want to bother, they don't want to bother themselves about the exchange rate. in that time, March. So they now decided that they went to meet a finance house, a company that, okay, you are going to supply $1. Let's assume that they need about $50,000 for this transaction. They now said that, okay, well, you will supply us $50,000 in February 2024, and we are fixing the exchange rate now for 1,600. This is the rate that we are blocking now. So in 2024, they are going to get this dollar at 1,006, but this 1,006, it is determined today. So if in 2024, this 1,006 turned to 1,007, both Professor Alabi and Toby, they will be dancing because they have hedged their transactions, right? They will still buy it for 1,006, irrespective of what the exchange rate is. But if the exchange rate is not in reverse at that time, that means, but they cannot cancel the transaction. That is what a forward contract is all about. So a forward rate is a rate that is usually for a future transaction, but that rate is determined today. So under expectation theory, your forward rate is expected to be equal to your expected spot rate. So there should not be much difference between that forward rate you are predicting for future and what is currently applicable now, spot rate. So that's what expectation theory is all about. Then the second one is liquidity preference theory. So this liquidity preference theory, what it's saying is that if I'm keeping my money with you for a long time period, you should be able to pay me a premium for keeping my money with you. That premium is known as your liquidity premium. Yeah, liquidity premium. Okay, just a few seconds, please. Few seconds, please. Just responding to a chat. Okay, so all right. Thank you. Okay. Thank you for holding on. All right. So I've explained. So if I'm keeping my money with you for a long time period, liquidity premium state that you should be able to give me a liquid premium for keeping my money with you. So under the liquidity preference theory, our forward rate is going to be your spot rate plus that premium for me keeping my money with you for a long time period. So that's what liquidity preference theory is all about. Then the third one is market segmentation theory. So this market segmentation theory, basically, the yield curve is determined by the forces of demand and supply. So we apply the forces of demand and supplies here to determine our liquidity or whatever. So what are the factors influencing the term structures? Okay, term structure. Note that the term structure is the relationship between your interest rate and the duration. Okay, duration and the interest rate, relationship between the two of them is known as a term structure. Okay, so that's for that. So I think we've discussed this patient inflation or whatever before. I've talked about that for a time preference now. So I think I've talked about this RM plus RL the plus inflation. So let's just move on. We've discussed this before. So because time is running, so this is the forward rate and this is the spot rate. So let's discuss convexity of a bond now. So because somebody raised an alarm that I should explain it again. So I will try my best to explain this convexity of a bond again. So, okay, I think, yeah, we are moving on. Out of page 79, we're on page 52 now. So I think I will have to rush, so we'll move on. So when we say convexity now, what is convexity of a bond? Note that convexity and duration, they are similar, but convexity is deeper than the duration of the bond. Convexity is deeper than the duration of the bond. So convexity basically is a measure of the relationship between a bond price and its yield. So the relationship between a bond price and its yield is known as the convexity. So it basically reflects on how the duration of a bond changes as interest rate changes. So how the duration will change as your interest rate change, that is what your convexity try to measure. The relationship between how your interest rate change as the duration change. So all the one I colored here, I deliberately colored them. Those are the keywords that you need to watch out for. So it provides a more accurate measure. It provides a more what? Accurate measure of the interest rate risk associated with a bond or a portfolio, especially for a large interest rate change. So it provides more details of those things. So what are the key concepts under this convexity? First is duration. Duration is the first thing you derive before you derive your convexity. So I will show you how to calculate that. Then convexity is the second one, which we've also defined. So Emmanuel, if you are here, speak. Oh, you ask me this question so that you don't private chat me again. Let's do it together here. Emma, speak if you are here with us. Okay, so all right, let's look at this question now on convexity of the bond. Sorry, somebody wanted to speak? Okay. All right, so this is the question now. APLC have a bond of 1,000 naira, 12%, with 5 years to maturity, and its yield to maturity is 14%. So you require calculate the duration of the bond. If you notice, the duration that Dr. Ojobo taught us, he gave us the price of the bond. But the one Professor Olowe taught us, he did not give us the price of the bond. We have to calculate it on our own. Okay, please note. So duration basically is the present value of all your cash flows divided by the price of the bond. So how do you calculate the present value? It's 5 years bond, so we have the 5 years. So your yield is your coupon multiplied by the face value. Yield is 12%. So 12% of 1,000, that's 120, Abi. So we have 120, 120, 120, 120. In year 5, it will be 120 plus 1,000. Okay, then you will now say your year multiplied by the yield. So this is 1 times 120, 120, 2 times 120, 240, 3 times 120 up to the end. Then you put your DCF at your yield to maturity, which is 14%. You put that one there too. Okay, then you calculate your PV. Once you calculate your PV, your total PV is something like this. Okay, so now this is our total PV, which is 3725. You can see it here. So what is now the price of the bond? So price of the bond is basically the DCF of all the cash flow, the present value of all the cash flow. So in year 1 to 5 is 120, which is this. Then year 5 is 1,000, which is this. So the value of the bond or the price of the bond is 931.3697. So you have that 931.36. So your year is coming to about, should come to about 4 years. Okay, so that's for the duration of the bond. Now the next thing is for us to move on to convexity of the bond. So under the convexity of the bond, it's still the same things that we are doing, right? However, we are not going to apply, we're going to apply what's it called, our DCF directly on the cash flow before we calculate before we multiply it by the year. So you can see we multiply our cash flow with our DCF. So whatever we got as our PV, that is what we now use in multiplying the year. So this is 105 times 1, 92 times 2, 81 times 3, and this time this. Then for the time now, for the time, you will add 1 year to each of the time. So year 1, it will be 1 plus 1. Year 2 will be 2 plus 1. Year 3 will be 3 plus 1. Year 4 will be 4 plus 1. Year 5 will be 5 plus 1. So once you do the time now, the next thing is that you will now multiply again. Now you will multiply your time by this new year you got. So once you do that, you will get this. So the total we have here is 2609. So your convexity is basically 1/2 multiplied by 1 divided by the present value. The present value, the one you got for the asset itself, which is 931.8. Then you multiply it by 1 divided by 1 plus r raised to power 2. R is equal to our interest rate, that's 14%. Then you will now multiply it by your PVT plus 1, which is this amount here. So once you do this now, our convexity is coming to about 8.5133. Olowe said don't put it in percentage and don't put it in years. Just put it exactly same value you arrive at. So the formula for convexity is 1 over 2 multiplied by 1 over PV multiplied by 1 over K plus this raised to power 2 multiplied by your X. Your X is your, what's it called, this convexity value you got here. So this is how we got the convexity of the bond. So the next thing we now do is that changes in what? In price of the bond. Okay. I think he said he gave us something on basis point, Abi. So the next thing is changes in the price of the bond. So before you can determine changes in the price of the bond, the first thing you need to do, understand the meaning of basis point. First of all, you need to understand the meaning of basis point first of all. So I think 1 basis point is equal to 1 divided by 100. Okay, 1 basis point is equal to 1 divided by 100. So therefore, your 50 basis points should be about 0.5 if I'm correct. 1 basis point is about 1 divided by 100. So here, he said changes in price if the yield changes by 50 basis points. So the formula is this, your minus D. This is your duration. What you got under the duration is D. So 1 plus KD, that's 40%. Then your basis point is what that thing, if we say basis 50 basis points, 50 basis points is 1 divided by 100 times 100. So 1 divided by 100 times 50, that will give us 0.5%. So 0.5 divided by 100 will give us this value. So the changes is coming to negative this. Okay, that's negative this. So you can see the calculation for 50 basis points is here. So you can see 50 basis points. So this is 50. So 1 divided by 100 times 50, which is 0.5%. And that gives us this. So, like I say, I'm not bragging. No. If the only thing you can use to revise for your investment is this material that we are using, I don't think you will fail the exam, right? I think you'll be fine. But if you have time, then you can now explore more textbooks or even past questions if you have the time. But if what you can just use is this material here, because we've covered almost everything, right? So the next one is the changes in price under convexity. If you change by 50 basis points, it's still the same thing, just that you apply the formula for convexity here too. So when you do that, you get about this. So that's for that. The next one is explain bond immunization. So bond immunization is the process of keeping the value of the bond throughout the duration. So if you compute your immunization with duration of 4 years, you will get the same answer. Prof proved that for us in the class, but I don't think he will ask us that in the exam. So, all right. So, I want to take like 2 minutes break. So maybe someone should just say something, or who want to teach us something, so that I want to take 2 minutes break to just relax, then I'll carry on from this. Professor Alabi, please teach us something you know on investment. For 2 minutes, teach us something that you know on investment, or whoever, anybody can teach. Bukumi Badmos, you can teach us. Emmanuel, you can teach us. Perpetua, you can teach us. Alabi, you can teach. Itoro, you can teach us. Faith, you can teach us. Anybody, for me, anybody. Just teach us, Pelumi, anybody. Just teach us 2 minutes while I catch my breath for 2 minutes too. So I'm holding on for you guys. Someone should speak for now. Otherwise, I'll take over in the next 1 or 2 minutes.
Maybe I can just say, because I'm not prepared for this lecture, that is just it. But I can just say what I know based on what you have said earlier under the portfolio management strategy, of which Olowe really mentioned on yesterday. Per se, he was talking about how portfolio management could be measured and could be managed and strategy to be adopted by a portfolio manager. He was talking about interest rate anticipation strategies. At the same time, he was talking about yield spread analysis and maturity spacing strategy. And also he talked about bond and hold as a strategy. We're talking about indexation and immunization and cash flow matching. All these are strategies to be used in managing portfolio issues. But under this portfolio management strategy, they are grouped into two. It was saying that when the manager is active and when the manager is passive, but it was not direct on the classification of the strategies to be grouped in each of the manager design for their portfolio management strategy. I can just group this under two.
Thank you. Continue.
Okay, under active portfolio management, strategy to be used is interest rate anticipation. That is one. When a portfolio manager is using interest rate anticipation, that is, what will interest rate be tomorrow? And what relationship has my investments as regards to the up and down of the interest rate? We know the relationship between the interest rate and bonds and how interest rate will affect the bond going forward. So when a portfolio manager is adopting this strategy in managing his portfolio, is can categorize that one as active strategy. That is when it's adopting interest rate anticipation strategy, that is under active portfolio management. Two, when portfolio manager is adopting yield spread analysis, how will the yield spread going forward? When he's looking at what the variation in the yield, so that manager is using active portfolio management strategy. And at the same time, when a manager is using maturity spacing, thank God we have done maturity before. How you calculate the duration? Sometimes when duration is equal to what? Is equal to maturity, that means that that means only applicable in zero coupon, where maturity and duration equals what? Is zero. So when it's anticipating the maturity of the bond and to know how to strategize in managing the investment portfolio that it has, is using active management strategy. And at the same time, when we now come to a portfolio manager that is very, how would I put it, that is relaxed. Yesterday he was talking about trustee. A trustee, the person that lay claim to the fund. Why a manager is just the one that just say, "Errand boy, do this for me, do that, do this." But it doesn't have 100% control over the fund. And we were using somebody as an example in the class that if such a person could be given, a chance to control the fund and at the same time control what the investment decision, that the money might go down the drain, that the trustee now will come in to ensure that the investment and the fund is accurately and judiciously managed towards the maximization of the shareholder, who has really of the investor who has really contributed this money. He was not saying that when a manager is using passive management strategy, he will be using buy and hold strategy. He will be using indexation strategy, and he will be using immunization strategy, and he will be using cash flow matching. And based on what the way I studied the man, that there was a day he was in the class, he was giving us how the value of the bond will not really different from one period to another if a manager is able to adopt a system of immunization. That day he was able to say, okay, in year one the value in year 1, and the value in year 2, and the value in year 3, and the value in year 4 will not change if
They're all the same.
they are all the same. So I'm watching for that question. That there's a likelihood that such a question might be tested in this our exam. I'm not just prepared for this lecture. I will give a calculative method and approach on how all those strategy is being handled by portfolio manager. That is the little I can see for my head based on what they have taught us.
I'm clapping, prof. That's why you are a prof now. You know, the level you took us to now is very high level. I'm very, very happy with prof. So who else again want to teach us? I'm also relaxing, you know. I've been talking for almost 2 hours plus continuously. Anybody again who want to teach us again for 1 or 2 minutes before I carry on? Just sort now. There are many brilliant people here. I'll call you guys out too. If you don't want to speak, I'll call you out too. We're ready. Oh yeah, somebody should just tell us something, teach us something, you know, anything on this course for 2 minutes. We still have about, I can still teach till 6:30, right? That'll be about 3.5 hours today. So let's carry on. I can still teach till 6:30 or maybe max 7 or thereabout. Let's see. Can I call somebody? Let me look for someone that I call. Toby, tell us what you know on investment. Toby. Unmute and speak. Teach us. Tell us anything you know on investment. Just tell us for 2 minutes. Toby, unmute and speak now. Toby does not want to speak.
Please,
Okay.
I just woke up, please.
Which time you don't sleep? Ale Omasu or so too soon. Okay. Pelumi Jayola, bro. Oh yeah. Can you unmute and speak? Tell us what you know on investment. Pelumi Jayola. Oh yeah, unmute Pelumi. Just tell us something for 2 minutes.
Bro, I'm still trying to catch up on so many things. Please. Let me just stay on.
Wow. I've switched to second page now. You know, I have grouping now. Page 1, page 2. Oh, which can I call? Okay, Damilola.
Can you hear me?
I know you. Yeah. Okay, somebody has picked up. Damilola, get ready.
Yeah, I don't know if you heard me. I said I'm still trying to catch up too. So
I know you are still trying to catch up. I get you. Understood. All of us are trying to catch up. Okay, Damilola, you want to speak? Tell us something.
No, sir, I'm also still trying to catch up. I'm still trying to catch up too because I wasn't fully paying attention. Thanks.
The Lord is our shepherd, though. Ima, my bro, I know Ima, you can't disappoint me. Oh yeah, speak. Ima, anything you know, just teach us for 2 minutes. Only profile I'll be. Yeah, so let me call on our econometric madam. I know Fumi cannot disappoint me. Oh yeah, Fumi, just talk to us in 2 minutes. I know you cannot disappoint me.
I'm still trying to catch up as well, though. Joe.
Wala ti wa dé báyìí. Okay. Let's carry on, sir. Thanks, Mr. Alabijare. Ẹ ṣeun gan. Ẹ ṣé, sir. At least for allowing me to rest more.
Yes, sir.
Okay. So let's look at this part. I still have a lot of things to discuss. Probably I might engage you guys till 7 p.m. So that will be that'll be 4 hours lecture. Or not before maximum 7, or not before 7, so that we don't start having law of diminishing returns. You know, if it is getting too much too, diminishing return will start. But one thing is guaranteed: tomorrow QT, you guys should get ready. It might be from 9 to 12 a.m. because tomorrow is the only and the final revision we'll be having for QT. It might run till 12 midnight, 12 a.m. So because I have to take all the topic at once, and that will be helpful for QT. Although investment, we are still coming back on Wednesday. So be prepared for 9 to 12 a.m. tomorrow for QT. All right, let's move on. Those of you that sleep a lot, maybe you guys should buy this drink. It will not make you sleep. There is this drinks called this. Go and buy. Get these drinks from any supermarket. Supermarket. What's the name of the drink? So it doesn't make someone to sleep. Get the okay. Somebody wanted to speak now. Maybe you know a better drink than I do. Who?
Is it 9 12 a.m. or 9 a.m. to 12 a.m.? I heard you said 9 a.m. to 12 a.m.
No, 9 p.m. I'm a Bishela eh? 9 p.m. to 12 a.m. You said what?
9 a.m.
Are you joining, Stanley? It seems you are joining us for the first time, Abi. This is your first time on this tutorial, Abi?
Yeah, exactly.
Okay, you are welcome on board. We run it from 9 p.m. till 11 every day, but tomorrow is going to be a special. So tomorrow we run from 9 p.m. to, what was it called? 12 a.m. tomorrow. So 3 hours in the night. So, guys, those of you that sleep, I can start calling them. Number one is the wrong. Let me name of class sleeper. Name of those that sleep regularly during lecture. Number one is Dinron. I know them very well. Number one, Dinron. Number two, Toby. Number three, let me call them. I know them very well. I will say them. Kafayat, yes. Number three, Kafayat. If you disagree, go to court. Number four, Fumi sleeps too. Who else again? Those that sleeps into class. Fatima too. I used to catch you once in a while. Fatima. And once in a while too. I think these are the top 5 I can remember. So those of you that sleeps, these people that I've called now, they are those that sleep a lot during class. So get this Monster energy drink. There is one like this. The color is white. Let me see if I can get it here. I will show you. Get it, drink it. You will not sleep. .com. Me, I'm trying to relax with what I'm doing now. Sorry, before I continue again. Monster energy drinks, new one. So you guys should get this drink. Yeah, this one is sweet. This white one is not bitter. Yeah, open. Why is this showing me something? Yeah, see this drink I have here. This particular one that is white, Alola, it's just about 700 naira or thereabout. It will not make you to sleep. Please get this drink so that you will not sleep tomorrow. So I'm referring to those that sleep a lot in class. All right, break is over. Let's get back to class now. Let's get back to class. We have Greenhouse Company. Hello, guys. Can you hear me? Hello, are you guys with me? Can you hear me?
Yes, yes.
Okay. Let's get back to class now. Greenhouse Company has a bond outstanding with 20 years maturity. Has a bond maturity. This is a past question. 20 years maturity. The bonds pay annual coupon interest at the rate of 8%. This is the annual coupon, 8%. The bond is currently selling at 761. Determine the bond precise yield to maturity and approximate yield to maturity. Like we said that precise yield to maturity is your IRR. Then for approximate yield to maturity, you apply the formula. So let's look at the precise yield to maturity first. So our IRR is basically the cash flow. It's 20 years, right? So we have year 0, year 1 to 20, and year 20. So year 0 is our fair value, opening value. So here now, the bond is selling for 761. That's our fair value. That's 761. Then what's going to be our coupon? Our coupon will be annual coupon of 8% of the 761. That's our coupon, which give us 60. That's 60 naira. Then this bond will be redeemed at par. Okay. Although we are not told, but if you are not told, you have to redeem it at par. And for every bond, the par value, it could either be 1,000 or 100 naira. But in this case now, the par value has to be 1,000. If the fair value can be 761, the nearest will be 1,000. Okay. So you do this now. So we did NPV positive, which was 10%. When we did 10%, which we first of all try 10%. It gave us a negative of 94. We now try 5%, it gave us this. Then with this, we now calculate our IRR. So that means our precise yield to maturity now comes to about 8.99. Okay, 8.99. Then for your approximate yield to maturity, so this is the formula that we use. So C plus F minus P divided by N, every divided by F plus P by 2. So you can see like this. So we got it. So we'll end up getting about 8.27% as our approximate yield to maturity. Then that's the A question. The B part says that the setting of investment objective is as important as the selection of investment assets. Identify and discuss in details the key factors of consideration in setting investment objective. Well, thank God. Sorry, they just brought our light. Just a minute. Let's see. Okay, let's carry on.
Hello, Mr.
So,
Kazim. Hello.
Yeah, bro. Yeah, very well,
Please, I
very
want
well.
to clarify something. For the coupon that was calculated, it's not supposed to be calculated on the normal value, right? Instead of this 761.
No, this 761. The
Because we
761
calculated it on
is
the
the
market price, right?
is the fair value of the bond. So coupon should be on the par value now.
Because I was thinking it
Okay.
should be
What did we use?
8% of
The
1,000.
coupon should be 8% of 1,000 now.
8% of 1,000.
No, how did you get 60, sir? How did you get 60?
That's 8% of 761.
No, it can't give us 60 now. Sorry. 60. It should be 8% times what? 8% times 1,000. That's 80.
Yes.
We actually made a blunder here. Thank God. Let's resolve it. Your coupon is on the par value. Please. So let's do it again. So we have 80 times 8.513. It's good we solve it because some people like cramming solution. 681.0. Thank you, my brother, for that. Thank you so much. I appreciate it. Yeah. So let's resolve it. Okay. Yeah, let's resolve it. So we do this now again. So
Sorry, please.
12.
Value.
Sorry, can you speak? I not get to you.
Par value. How did we get the par value?
1,000. The par value of a bond is either it is 100 or 1,000.
Okay.
So in this case, it will be 1,000. So I'm just adding it up again. So here, minus 761. So my NPV is 68. This is 68.728. Okay, this is 68.728. So let's do this one again. So 996.976.376.89 minus 761. 612. The spread will be too high. So let's quickly do this again now. MPV, this will be, please help me if you can calculate fast, please. 612.866 into 612.866. And here we have 68.728. Yeah. So what's the answer? 612.866 plus 68.728. Okay. 612.866. So I'm getting 9.49. This is what I'm getting. So you can confirm, Sha, if that's not it. So thank you for the correction. So it is not corrected. Thank you. So the B part of this question states that the setting of investment objective is as important as selection is as important as selection of investment assets. Identify and discuss in details the key factors of consideration in setting an investment objective. So whenever you want to set an investment objective, what are the key factors that you need to consider? Should we brainstorm on this question, or I should just read the solution and we'll move on? Okay, let me just read and move on because of time. So if you set an investment objective, the first thing you ask is the time consideration. Is the investment a long time, or is it for a short time or a long time duration? That's, you need to consider it. Then after you have considered that time consideration, please just notice, one is time, the second one is the risk tolerance. Okay, risk tolerance. The investor, is it someone that can take a more bigger risk, or he doesn't want risk at all? Okay, some people want a very big risk, some want a lower risk, some want moderate risk. For somebody that doesn't want any risk at all, just give the person treasury bill, or what's it called? Either you give the person treasury bill or bond. Those one carry almost zero risk. Okay, so that's for another one. Then liquidity need. When do you need your money? How urgent do you need the money? So that one, so you consider. So I've listed three things, right? One thing I listed is the time. The second one is the risk appetite. The third one is the liquidity risk. And the fourth one is your knowledge and experience about investment. Okay. We have some investors that are novice, while some are experienced. Then income requirement. Do you need your interest upfront, or do you want them to pay your interest on quarterly basis, or will you like to take your own interest on maturity? So those things need to be considered too. Then what about tax considerations too? You need to consider the tax considerations too. You know, there are some investment that you can do. They carry zero tax rates, right? Why some are attractive to tax rate? E.g., I think government security, government bond carries 0% tax rate if you do government security. But if you do investment with all these other small other people that is a non-government, you are liable to withholding tax. If I'm correct, I think that's a, but government bond or those one are exempted. So you consider your tax considerations too. Like if you do treasury bill now, if you do all these fixed deposits, under your income that they are paying you, they are going to deduct 10% withholding tax on your income. You'll be paid net of withholding tax. So you consider tax, you consider return expectation. So my legal and regulatory constraints, ethical. So my advice is just know at least 5. I've listed how many points here? 10 points. Just know at least 5 points very well, so that you can write on those 5 points. Anything you know above 5 points is bonus, but know at least 5 points, and you should be able to write on at least 5 points. Now, the next thing we're discussing is the third part of the questions. Let me look at the third part of the question. The third part states that the investment decision for an individual can be viewed as a 4-stage process. Discuss this 4th stage in the investment process and issues at each stage. So what are the 4 stages in investment process? The first one is you first of all set the objective of the investment. Okay, what is the objective? That's the first thing you set. You can read more on it. Then the second one is you develop the investment policy. So please read more, or what you need to read that here. Then the third one is you now construct your portfolios. Okay. Then the fourth one is you now keep monitoring and rebalancing of your portfolio. So those are the 4 things that you need to consider in setting up an investment objective. So let's look at the next one now. This one too. This was a question that Professor Olowe solved for us in the class. Still on bond though. We've not discussed portfolio in details. We're almost there. So ABC Limited has just paid a dividend of 80 kobo per share. A director of ABC Limited are of the opinion that an investment will grow at the rate of 10% for the first 10 years, after which it will increase to 12%. The current earning per share is 4 naira, and shareholder required rate of return is 15%. So the industry earning is expected to be 9 in 10 years. So calculate the current market price. You know, this is an example of a multiple growth system for an investment. This is an example of a multiple growth system for an investment. So if an investment have a multiple growth system, there are 2 formulas you can use. Okay. This is the first formula is for 2 growth model. I think that, you know, the question we solved earlier on two growth. That question that we solved, I don't know if you guys can remember today. That one use the second formula. But this formula that you see here, you can only use this formula if this statement that is in color here, if you are giving this statement, you can use this formula. I'll always said it in the class. So this industry, whatever. But if you are not giving this clause, then you have to use that first formula that we used previously in solving our first question. So please, the formula you are going to use depends. So what I will do is that today, God, before I sleep, I'm taking it up as a challenge. All the formulas that we have in bond valuation and portfolio, I will try and write everything out for you, and I will write few comments when you can use each of the formula. Maybe that will serve as your Bible from tomorrow to start cramming it. So in case I send it, if any of this formula is wrong, please quickly send me a WhatsApp to WhatsApp, because I don't know how viral that whatever I'm going to say. I don't know how viral it will go. Thank God I will not put my imprint there. It's from the sky. So if any of my formula and assumption is not correct, please speak. But I'm going to take it up as a challenge before I sleep tonight. All the formulas in investment, I'll write everything out for you, and under which circumstances you can use each of the formula. I will share that with you tonight. So please, so that you can even do an assessment. If there are about 20 formula and you only know 10, you know you have 10 more to cram, Abi. Whether you are going to write those 10 in a paper, burn it, mix it up with your alcohol and drink it. You know, with that's a faster way of cramming something, Abi. You just go and burn it, squeeze up the dust, put it in any drink and you drink it. You've crammed it automatically. So that's at your own risk. Caveat emptor. So this formula you see here, you can only use this formula if you are given this clause that industry earnings is expected to multiply. But if this clause is not given, then you use the other formula that I gave you before. Please take note of this one. Take note of it very well. Okay. So if you apply this formula on this question now, you should get this answer. I'm sure you can all review this. We can check it on our own. It was class questions, right? So we can. Okay, let me carry on. So if anything is not clear, please, I can still explain. But me, I'm moving on. I assume that you all know this question. You can solve it with all the information given. Okay. So this is another question now. This is another question. Olowe. Olu bought UAC share. Olu bought UAC share when it was selling at 15 naira, and he later sold it when it was selling for 60 naira. A dividend of 5 naira per share was paid during the holding period. Calculate Olu rate of return. So you see, I solved this one for you, Abi. PT is the selling price, minus PT minus 1 is the price at which you bought the investment, plus D, dividend they declare, divided by PT minus 1. So it will give you the rate of return, which is 30%. So then, and I also solve another past questions for us. This is another past question we solve. Still on bond, okay? We solve these ones too, still on bond. Recall that what we are doing today is just general revision, okay? General revision of everything we've done is what we are doing today. Okay, so assume that in March 2004, Lagos State government issued a security of 7.2%, 30 years bond at, I think it's 1,000 per value. Interest rate rose substantially following the year of issue, and the price of the bond declared in March. The bond had dropped from 1,000 to 650. Assume bond paid interest annually. What was the yield to maturity of this bond when they were issued and in March? So the yield to maturity is your IRR. Okay. Note that there are 3 different types of yield. Yield to maturity is IRR. Okay. Yield to maturity is your IRR. Current yield is equal to your coupon divided by your PO. Then approximate to maturity, you see that formula that I show you. I'm sure you can remember it. So please know, this is the formula I wanted to start building up today before I start up the class. Okay. So please take note of this very well. So you compute your IRR when they were issued, and also in March 2015, which we've done it. So that's just the value. That's the answer. All right. So the next thing is the importance of duration in bond portfolio management. What is the importance of duration? Okay, so this let's move on this. So this one you can read it up on your own. Okay. Then there is another questions too that we solved. Look at the questions there. Jacob PLC, which presently pay dividend of 2.4 per share, has a current earning per share of 3.9. Because of the current investment program, earning and dividend will exhibit a phased growth rate. The company expects dividend to grow at an annual rate of 30.5 in the first 4 years and 16% thereafter. Investors in the company require a rate of return of 24%. Calculate the current market price of Olu. So this is similar to what we did before. So you can see the table. I gave you the table here. So please just follow the same format of the one we've solved before, and I'm sure that you will be fine. It's the same one. We've solved this thing like twice today already. So just follow the same format. You'll be fine. So then we now move on again. This is another one. This is another question. So this one was the class test. The test that we wrote on investment. This was a class test. A company have a bond of 1,000 naira with 14% coupon, and interest is paid semi-annually. Yield to maturity is 14.3/4%. Duration of the bond is 6 years. Calculate the price. So basically, the poison that Professor Lowe included in this is interest is paid semi-annually. That was the poison. So I think many people ate this poison. Then it was so delicious, actually. The poison was delicious, so it was well eaten. All right. So if interest is semi-annually, let me just show you. Your coupon rate will be divided by 2. Okay. Your duration will be multiplied by 2, and your yield to maturity will be divided by 2. So that's how you do your semi-annually for bond. So 7% of 1,000, that's 70. So you just use that as your basis to get the value pricing of the bond. So you can go through this. Then the next thing we now move on to was portfolio. So we move on to portfolio theory. Okay, so I think we should end this class in about 1 hour time. Okay, we should end this class in 1 hour time so that law of diminishing return does not set in. We should end this in 1 hour time. So let's move on now. So we have this now. Given the following security A and B of Lower PLC, calculate the expected return of the individual asset. Calculate the standard deviation of the individual asset. Calculate the expected return of the portfolio. Calculate the standard deviation of the portfolio consisting of 60% investment in security A and 40% investment in security B. If the correlation between A and B is 0.7, then 3, assuming 3 scenarios, advise on the security with maximum return. That is perfect positive correlation, A, perfect negative. So if you look at the questions now, the easiest ones to do is to calculate the expected return on the individual assets. So what you will just do is that, like for asset A now, it's going to be 50%, that's 0.5. It will be 0.5 times 0.3 plus 0.3 times 0.5 plus 0.05 times 0.2. That will give you the expected return for security A. Then for security B, you have 0.5 times 0.6, 0.7 times 0.3 plus 0.8 times 0.1. So that will give you for security B. So expected return is this. Where this one is a bonus mark. Quickly collect that mark and pocket it. Okay. Then the B part state that calculate the standard deviation of the individual asset. Calculate the standard deviation of the individual asset. We have asset A and asset B. So you do it separately. For asset A, so you get your expected return, then your possible return minus your expected return. This one will be 0.5 minus 0.31. It gives us this. 0.3 minus 0.31 is give us this. 0.05 minus 0.31 is give us this. Then whatever you have here, you square it and multiply it by the probability. So this 0.19 square multiply by 0.3. So it gives you this. So you do this. This will give you whatever answer you have here is your sigma square. This is your sigma what? Square. I still made a mistake yesterday, but somebody corrected me that your sigma square is your variance. So your sigma square is your variance, which is your sigma square variance. So when you now square root of this variance, it will now turn to standard deviation. So this is the variance of the security, and this is the standard deviation of the security. So this is for asset A. You repeat the same process for asset B. So once you are done with that, then you have answered the B part of the question. Then the C part of the question says that you should calculate the expected return of the portfolio, which is also a bonus mark. So expected return of portfolio is simply the weight of A multiplied by the return of A plus weight of B multiplied by return of B. That will give you the expected return. See, the way this thing is, when we enter the exam hall and this portfolio come out, something like this, please, that one is a sure bet mark. Quickly go and start with that. Collect that 17.5 mark and keep it in your pocket, first of all, before you go to bond. I'm begging you, please, when you see your question and this portfolio come out, quickly rush this portfolio. Okay, I will teach us time management skills on Wednesday. Okay, we will be given about 2 hours and we have to attempt 4 questions. So let me even say it now. So 2 hours to attempt 4 questions. What implies is that don't spend more than 25 minutes on this question. I mean it, 25 minutes. So that means 2 questions will take you 50 minutes. Anything you are solving on one question and 25 minutes is up, please stop and move on to the next question. Why? Because it is easier for you to earn 1 mark when you are starting a fresh question than trying to balance a question that you have been solving for over 20 minutes. So please, 25 minutes, 1 question. So when you attempt, what they say we should attempt, not that we should solve. So when you attempt 4 questions now, 50 minutes, that's about 1 hour, 40 minutes, Abi. You are still going to have a beautiful 20 minutes left for yourself. So that final 20 minutes that is left, you will now use that 20 minutes to go and do your shock absorber. Any question that you want to go and balance it. Like, at least just use that balance. Last 20 minutes is for you to run through all your solution again. Please, don't come out and be saying that, I was able to attempt 2 out of 4 because there is no time. It's a poor time management skill. So please, don't go in with a smartwatch. I know they might think maybe you want to cheat with time. Just go with a very small watch that, if it's analog watch that will program that, you can use to monitor your time. Because once we're in the exam hall, that 2 hours is always like 2 minutes. So don't be surprised. Don't be surprised. Most especially if you know it. If you know it, the time is always very short. But if you don't know it, the time will be too long for you. If you know it, because you'll be busy writing. And when you are busy writing, time is going, you will know. Sometimes you'll be thinking that what have I written? It's almost 2 hours. But if you don't know it at all, there is nothing you can do. It's either you sleep or you just give up from there. You accept your fate that you're coming back to rewrite it. So I pray that won't be our portion by God's grace. So please make sure you do your time management very well. Like I said, each question don't spend more than 25 minutes. So that when you have attempted the 4 questions, you will be having about 20 minutes left. You use that 20 minutes to go and do your patch all round before you submit. So that's just what I want to tell you. This is what I used to tell my students in ICANN then, that their principle really do works for us. It works because what we're after is to attempt, not solve. If I attempt it anywhere I stop, please take it like that and let me move on with my life. Okay. So that's expected return of portfolio is done. Standard deviation. I think Fumi gave us this the other time. This formula. So just know it. This is just two security formula for 2 security. Weight of A squared into variance of A plus weight of B squared into variance of B plus 2 weight of A weight of B. Then coefficient RAB of RAB into standard deviation of A standard deviation of B. So that's it. So once you do that, that's just your answer. Note this sigma square is your variance. The standard deviation is without square. Okay. Oh, what am I copying? Standard deviation is without square, please. So this portfolio, I want it to be a bonus to all of us. Once we enter the exam hall, I will see this portfolio. All the verse. Let's finish this one. Take out that one. then we can now move on to others. Please, I beg you, this should be a bonus for everybody. And if you are still struggling with this portfolio, please, you can speak out. Oh, okay. Yeah, these other ones too, we've done it when the positive correlation is +1 or -1. So when it is +1, like I said, what you just do is that your RAB, you make it +1. If it is -1, make your RAB -1. And if it is 0, make your RAB 0. But once it is 0, all this entire stuff you have here will be 0. You will just do this plus this, and that's all. So you can also practice that. We've done it already. Please practice, and if anything is not clear, let us know. So now there is a little that we can do in the tutorial. Most of the work now lies with individual. Yeah, most of the return now lies with individual. Okay, so most of the work now lies with individual because we have done our own part. Okay, so that's just it. So let's just carry on with the other aspect. So let's done. So you guys need to, like what this man used to tell us, Dr. Shitu, we need to make your hand dirty. If you are still the type that you are scared of solving question, an exam is next week on your name. Or your, if you are the type
Exam
that
is
you
this
don't
week. Is this week now? It's not next week.
why are you scaring us now? Shebi, it is just Saturday, Abi. You are very correct. Exam is on Saturday. Oh, please. If you have not solved it, some people I know they have never solved any one question bill. Hey, my AirPod battery is getting low. Okay, let me plug one ear to be charging. I'll be using one ear. By the time this other one is about to die, I will change it again. Okay. Can you guys hear me very well? Because I'm using one ear now. Can you hear me very well?
Yes,
Hello?
yes.
Okay. So, like I was saying, let me just pause and speak to some people. I know there are many people that fall into this category. I know some people have never solved one question before since we started this semester on investment. If you are the type, can you speak? I know maybe they may not want to speak. If you are the type that you've never solved one question before, can you speak?
Aye.
Thank you, ma'am. God bless you for being honest. Pelumi Jayo. You also Pelumi. Who else again? Who else again? Okay, those are the two people that are probably bold enough. Okay, Emmanuel, God bless you.
Hello. Hi. Hi.
What Pombe? It's okay. All of you are raising your hand. Kilo day, it's okay. Oh yeah, drop it. People don't verse. Everybody raising hand. Oh yeah, Jawole, for me, bring down your hand. Michael, bring down your hand. It's okay. Yeah, Itoro. Oh, it's okay. Oh yeah,
Sorry,
bring it
Casey.
down. Oh yeah, let me
Please
talk to
help
them
my
now.
life. Casey.
How can I help it? How can I help it, ma? How? Explain, ma.
But you made mention about something in standard deviation. You said if there is no something that we should ignore the two weight of A, weight of B, something. Can you please repeat it?
Okay,
If that would
I'm coming.
help me.
Yeah, Michael, do you want to speak? Michael, do you want to speak, or you just raise your hand because you've not solved any question this semester? Michael, yeah, drop your hand now. Or do you want to speak? If you want to speak, unmute and speak. Okay, let me help him to drop his hand. I've lowered his hand for him so that the hand will not be paying him. He has been raising his hand since. So, madam, what I was telling you is this. I'm coming back to speak with those that have never solved question before. I'm bothered on you. Just don't worry. Okay. Like if it is a positive correlation now, the same formula you have here now, this RAB, just change your RAB to 1. Okay, just make this RAB, make it 1. Then all of that should be okay. If it is negative, you make this your RAB -1. And if it is 0, The moment this thing is zero, if you calculate it mathematically, everything here, madam, will be zero. Everything will be zero. That means you only need these two alone for your zero correlation. You only need these two to calculate it. Yes, that everything here will be zero. So for those of you that are scared of investment, I have a good news for you. Please, if the only or you have never solved question before, so please, every question that we've solved in this material, which I'm going to drop now on our WhatsApp platform when I'm done tonight, just solve it again in your own. You should write it. Don't read it from the computer or printer. Use your hand to solve it one by one. If anyone is not clear, please post it on the platform. I'm not guaranteeing if I will have time for over 60 people on the platform, but at least if you post it, I know some of my guys here, Mr. Professor Alabi and Co, they can also comment to help me too. They can comment and guide you. This is not a time for anybody to be ashamed of anything. So please, anything we solve here, you too, get your own notebook, use your hand to solve it again. This portfolio now, this is the one that everybody let the more fast. This is the one that we can all verse and solve. So please use your own hand to solve it, like I did yesterday. I did it 2 days ago. I was doing it on my own. I so many things I assume that I know. When I flip through books, I assume that I know it. But when I'm solving it, I know that I will make mistakes. So please, that is what I'm saying, that try and get your hand dirty in Dr. Shitu's word. You have to practice, solve it. Don't read from the system. Don't read from your paper. Use your hand to solve it, please. So if you have never solved anything before, this will help you. Okay, don't let exam day be the first time that you will be solving question. No, it might be disastrous on that day. So that's my advice for you. So kindly pick a question and solve. If this is the only one, all what we have done is what you can solve. At least it's something. So please start from somewhere. Now, this is a past question, 15 marks question on portfolio, which we solved the last time too. So consider a portfolio made up of two securities, A, X, and Y, with the following probability distribution X, Y, Z. So we hire Y. So they said you are committed to invest 60% or 40% in the budget to this security. So I was going through the scenario, positive, negative, and uncorrelated. So determine the maximum return. So it's very easy. So the first thing you will do is that you cannot just jump into maximum return. You must first calculate the variance and standard deviation of each of the portfolio. So which we did. We did for AX, we got the variance and standard deviation and expected return. Then for Y2, we got the same thing, standard variance, standard deviation, and expected returns too. Then we now work out the perfect positive. So the perfect positive correlation, this is the formula for it. Or if you don't want to use this formula, just come to this your two variance portfolio. Change your RAB to +1. If you don't want to use, in my own case, I will not cram this formula. Never. I will never cram it. I will maintain that initial formula. I will just be changing my RAB. So I will change my RAB to +1, get my answer. For negative, I will change my RAB to -1, get my answer. For 0, I will change my RAB to 0, get my answer. Okay, that's a shortcut. Just know that long formula and change your RAB straight away. So, but note that the best diversification is negative correlation. Okay, so if you check, that one gives us it will always give you the lowest. Your negative correlation will always give you the lowest. So that is why negative correlation is the best correlation. It will always give you the lowest. That is why negative correlation is always the best. So then I saw this ones too, coefficient of variations too. We didn't solve any question on it, though. They might ask us to solve it. It's very simple. What is the coefficient of variation? It is a relative measure of risk, right? It is basically used in measuring risk. That's what coefficient of variation is all about. It is used in measuring risk. Okay, so the formula is your standard deviation divided by your expected returns. That's your coefficient of variation. Your standard deviation divided by your expected return. So let's look at these questions together. Calculate the coefficient of variation and identify the risky security. Calculate the coefficient of variation and identify the risky security. So like now for security A now, let's do it together. We have A and B. So coefficient of variation is equal to, for A, it will be 0.25. 0.25 divided by what? is 0.25 divided by 0.15. Okay, that's your coefficient. For B, it will be 0.28 divided by 0.16. That's for B. So what's the answer? This one would be 0.25 divided by 0.15. So the answer is 1.667. Yeah, 0.28 divided by 0.16. No, 0.28 divided by 0.16. The answer is 1 point. So who can tell me the riskier asset here? Which asset is more riskier here? A or B? Which asset or security is more riskier? A or B? Which one is more riskier? Or if you are an investor, which of these two assets will you go for? If these are the two only options you have ever. If these two are the only option you ever have, which one will you go for? A or B? Anybody? Anybody, please. Which one will you go for if these two are the only investment that you have? Are you going for A or B? Which one? So let me just answer you. The higher the coefficient of variation, the riskier the asset. So the A is still a less riskier asset because the coefficient of variation is less. So let me write the higher the coefficient of variation, the more riskier is the asset, and vice versa. So this is a coding. Just decode it. Okay. So portfolio selections now. Let's look at it. So this was the one that I think they taught us in class yesterday. So we are gradually coming to the end. I will discuss the portfolio selection. I will discuss the efficient frontier as much as, I will explain that graph with us, that efficient frontier graph. I will explain it. So I will tell us what we should know about the efficient frontier. We will draw the difference curve, all those things. Then I also want to explain the difference between your capital market line and what is it called again? We have the capital market line and we have the security market line. I would like to explain the difference between the two, the capital market line and the security market line. So I think once we do that, we'll be driving home today to the end of the class. Okay, so let's move on to the portfolio selection process. How do you select portfolio? The first thing you consider when selecting portfolio is the investor's preference, right? So like we were taught that every investors will always go for an investment with higher returns and lower risk. So the way we're taught is that your investment preference, it will show, you will draw up your indifference curve for all your investments. So this is like how they draw their, in economics, the way we draw our indifference curve is different, right? Our indifference curve is converse to the origin. But in our investment, the indifference curve is drawn like this. So here now, the higher the indifference curve, the higher the returns. So if you check now, we have indifference curve 1, indifference curve 2, indifference curve 3. So an investor will likely go for indifference curve 3 because that is higher than what the indifference curve 2. So the investor's preference always consider how an investor would like to balance the risk and returns on an investment. So being that is made, so once that is considered, let's now look at the efficient frontier. So for example, indifference curve show the portfolio and investors can go for. It's usually show one, okay? It's usually show a single portfolio. But so let me ask you, the difference between efficient frontier and indifference curve, okay? Let me say it. I'm recording this class since, so get ready to download a high volume of data file when I'm done. So there is a difference between indifference curve and efficient frontier, right? Indifference curve shows what? it shows just for a single portfolio the possible return and risk. But when we talk about efficient frontier consider the possible risk and what? It's consider the possible opportunity set. That is a combination of different investments that you can go for. It gives you like a buffet. If you go to all these big restaurants, they have a buffet, right? Which will show different food items that you can go for. Okay, that's efficient frontier. Efficient frontier will show you buffet, different this thing. I hope I'm drawing my efficient frontier very well. Okay, then when you have the efficient frontier, there is something that goes along it. That's what is known as your, it has to touch it by force. So, what to touch it. This is your CML. I will explain what is CML too. Capital market line. So then there is also what is known as the indifference curve. Let's say this is my indifference curve like this. This is my indifference curve. Sorry if I didn't draw it well. So let me name this one B. Okay. Let me come here, name it A. Okay. Let me name this one A. Let me name here C. Let me name this one D. Okay, D. This is D. So, you know, my B is this joint. This is my B. Okay. Now, so let me now come here. I'll put my E here. Inside here. E, let me call it. Apart from E, I still have F inside here. Then I still have G inside here. Then somewhere around here, I have H. So I want to explain each of these investments. What is the implication? What happens to them? So let me stop my diagram here. So it is possible for you to have multiple indifference curve, but note that optimization, your point of optimization is when your indifference curve is tangential. Okay, the point of optimization is when the indifference curve is tangential to the efficient frontier curve. So who can tell me my point of optimization here, please? And somebody tell me what is my point of optimization. Which of the investment is the optimization, the point of optimization? Somebody quick. Eh? So based on the, let's interpret now. Based on the above, portfolio B is the most efficient, right? Efficient portfolio. Okay, now who can tell me what are the list of all the efficient portfolios that we have? What are the list of all the efficient portfolio? Can you list them for me? So note the most efficient is B. Okay. However, the following are the efficient portfolio. Can you tell me which one are the efficient one? Tell me.
Yeah.
Portfolio A, portfolio A, portfolio C, portfolio D,
portfolio A,
yeah,
D,
portfolio
B, and what?
Portfolio B and C.
And what? C. Because any portfolio that goes around your efficient frontier, this efficient frontier here, any portfolio that touches this efficient frontier are the efficient portfolio. So anyone that touches this efficient frontier, these are the efficient. So it is among those efficient that you will now decide which one is the most efficient. All of them are good. A, D, B, C, they are all good. But among them, one must carry first. The one that carry first is the one that is tangential with our indifference curve, which is portfolio number what? B. Okay, now this now leaves me to explain. Okay, I'm not done. I want to explain capital market line and security market line. Okay, I'm still coming small. Borrow Bonnie. Now, who can tell me what happened to portfolio GEF? Can anybody tell me? What happened to portfolio GEF? Anybody? What happens to portfolio? What do we
They
call
are
them?
not
What do we call
efficient.
them? There is a name. They are all in a cell. What do we call this cell? This cell, they are all in a cell, in a cubicule. What do we call this cubicule or cells that they have?
Opportunity set.
Opportunity set.
Opportunity set.
You clap for yourself. You people are
Okay.
moving me. My head is swelling up. In fact, we are moving this thing to 8 o'clock. This is
That
my
shows
head is
money
swelling.
now.
We have the way I'm explaining, and you guys are clicking, it's making me to be happy, right? So if I'm happy, that means this class will not end. We'll just continue. So if you don't have data, don't worry, you can speak out. I will tell my people to give you data here. If there are big boys on this call, they can share data with you. So this is opportunity.
I don't have data.
You don't have data, Abby? Okay, that's for me, Abby. Is that for me? Or who speak now?
Yes.
Okay, 2.5 GB for you. Approved.
Yes.
Signed.
Yes.
I said 2.5 GB for you. Approved, signed, and it will be delivered. Who is that? Who is speaking that you need?
Yomi.
Okay, Mary, is it MTN that you are using?
Yes.
Chat me with your
I
MTN
need
line. But you
also.
guys,
I need
Emma
also.
Sorrow. My head is swelling up. Yeah, if it is too much, I will divert the
I
risk to
need
other one.
also.
So I'm giving Fumi, I'm giving Mary MTN. Send me your MTN line now. Fumi, I have your own. Don't worry. I have. Mary, send me your MTN line. You are collecting 2.5 GB. 2
Okay,
days.
thank
What
Mary,
about me?
who is
What
that
about
speaking?
me?
Who is speaking?
Oluremi.
Send
Oluremi.
your MTN line. Send me your MTN
Yeah.
line too. You get your. So
Okay.
3 of you that need data. I
Thank
know I've
you.
delayed you guys today. 2.5 GB each. I think that's all. Who else again? Only 3. You can see my guys are so rich. No guy is asking for data. Yeah, they are too rich.
Okay. Thank you.
You better come out straight. If you need data, tell you I need data. Which one is share and reach my side? Come out straight now.
Share and reach my side.
Please, all of you that you say you need, just send me your message me with your MTN line. I can't remember everybody's name or I may not remember. Just message me with your MTN line. I will send you guys 2.5 GB each. Okay, let's continue. So you guys, as I'm explaining this thing, and you people are picking it, it's making my head to swell. So now we know that portfolio B is the most efficient, right? Then portfolio A, D, B, C. These are the ones that are efficient. Although among all the efficient, one will be the most efficient, which is B. Why is B the most efficient? Because B falls, it is tangential with the indifference curve. Now, I said GEF now. What happened to GEF? GEF are not attainable. Okay, they are still within the opportunity set. They are under the opportunity set. So even what happened to H2? Can you guys tell me what happened to H? What happened to H?
Attainable.
So GEF are not attainable because they are within the opportunity set. Okay, let me write it. G, E, and F are not attainable. They are all still within the opportunity set. Okay, H is also not attainable. Now, so I've been able to explain these grammars very well for us now. I've been able to explain all this now. Okay, now the next thing I want to explain is this. Now let's now discuss. There are two things. We have CML and SML. Okay, see, I'm entering CAPIM already. Emitting what CAPIM near straight away. So there is something called CML, and so when we say capital market line CML only focus on efficient portfolio. Okay, your capital market line only focus on the what? Efficient portfolio. So this line that I draw, straight line, is my CML. So my capital market line will focus on portfolio A, D, B, and C. Okay, the capital market line only focus on the efficient portfolio. Why the second one, security market line, focuses on the entire portfolio, whether they are efficient or not efficient. your security market line focus on everything, whether they are efficient or not efficient. But capital market line only focus on the efficient portfolio. So I have a more explanations here on my ChatGPT or my Oracle. Let me open it. We read it. So why raise hand? Who is why? Please speak. Who is Yomi? Who is Yomi? You raise hand.
Yes, my question is that point B, can we call it optimal point?
It's the optimal point now, and it is the most efficient. Is that not what I said? Point B is the optimal point. The point of optimization. Point B is the most efficient or the optimal point. It's the same thing. It's the most efficient or the optimal. So look at this screen very well. I want to explain this. They might say, they might say a past question. I saw it differentiate between capital market line and security market line. It's a past question actually. So see, capital market line, like I said, the capital market line represent the risk return trade-off for efficient what? Portfolio. Can you see it? It represents the risk and reward framework for efficient. So note, your capital market line only focus on those ones that are efficient. Okay, your capital market line only focus on those ones that are efficient. But security market line, that one focuses on every portfolio. See, the security market line represents the relationship between the expected return of individual security portfolio. So it focuses on everything. So this is for security market line. So is a past question. They say differentiate between capital market line and security market line. So it is a past question. So I've just answered that now. So let's still move on now on the ChatGPT. So I now ask the ChatGPT, can you tell me the difference between the two through a table? And ChatGPT gave me the answer. So capital market line, see, represent the risk return trade-off for efficient portfolios combining a risk-free and a market portfolio. See, the keyword is efficient when you are defining CML. But for your security market line, represent the risk return relationship for all individual security. You can see this security is for all individual security portfolio based on their systematic risk. So that's just the difference. So I don't know. Can I just crop out this thing for you guys to see? Can I crop it out? Let me try.
Yes, please crop it out.
Let me crop it out. And if you have ChatGPT, please, is your Bible or Quran. Let me crop it out for you guys. So please note this difference between CML and SML. It's very important. Hey, this airport too. I think this one should have charged for. Let me remove it. Okay. All right. Can you guys hear me? Can you speak? Hello? I want someone to speak. Can you hear me?
You, bro.
Okay.
Yes,
okay.
we can hear you.
Thank you. It's my AirPod that is telling me low battery here and there. Okay, so let's move on now. We've defined the capital market line and security market line. So I want to round up tonight. I think so the CAPIM, I've not really dealt with CAPIM the way I wanted to, because there are some questions that I saw in the past questions under CAPIM that I would like to take. I would like to teach CAPIM as a topic up to where Professor Olowe stopped and still solve some past questions for us. So, but let's move that to Wednesday, okay? When we'll be having our final revision on investment. So Wednesdays too, please prepare to be with me for minimum 3 hours from 9 to 12 a.m. Okay, as the spirit directors. Worst thing is that you guys will resume to work late the following day. But I think it's worth it. So same one for tomorrow's too. And if we finish on time, we'll close on time. It's not compulsory that we stay till 12. We're not doing secret court meeting. So I want to solve the questions that Professor Olowe gave us last week. Okay, there are still many things I've not talked about. So I've not discussed arbitrage pricing model with us. I've not discussed portfolio management, even though Professor Alabi tried to explain a few things on portfolio management, like the open-ended, closed-ended. Please, let me move this one to Wednesday, okay? I just want to solve this question because on Wednesday, I want to solve only past questions that are related to CAPIM and other bond questions on Wednesday. So let's just take this one. And after we are done with this, we will sign out for tonight till we meet tomorrow, 9 p.m. So this question was given to us by Professor Lowe. He now said that I've not finished typing it. The expected return from the market portfolio is 19%, and the risk-free rate is 12%. Okay. Rank the portfolio using A, sharp measure, B, okay, this was what Trenor measure, and C, Jensen measure. So he said we should rank the portfolio using A, strength. So we have to do it one by one. So permit me to, I will just draw a table. I will draw a table for it. So I will draw a table for it. So we use all these things for performance, 3 measurement of performance or 3 measurement of portfolio. So these 3 things you see here now, they are using measuring the performance of a portfolio, right? These are using measuring the performance of the portfolio. So let's start with A, sharp measure. So let me draw a table. Where is my insert table? Insert table. So share. Insert table. So I have it here. I'm going to have my portfolio A, B, C, D. I will have my workings here. My workings will be, what's wrong with you? My workings will be here. My answer will be here, and I will have my ranking. Okay, so sorry guys, are you with me or everybody is quiet?
We are with you.
Thank you. So we want to use sharp measure, Abi. So this is portfolio. So this is portfolio. This portfolio, we have it. What is this? Why is this one not? Okay. So we have how many portfolio? A, B, C, D, E. A, B, C, D, E. Okay. A, B, C, D, E is the portfolio we have. Just okay, that's portfolio. Then workings will be here. Working will be here. We have our answer here. Then rank, we will rank it here. Okay, we'll do the ranking there. Okay, now, so for when you are using sharp measure now, the formula for sharp measure is your RP minus RF divided by what? Divided by, what's it called? By your standard deviation, that's sigma P. Let me just call it standard deviation. You know, the standard deviation is sigma, so I don't want to be looking for sigma up and down. Just take it as sigma. So this was the assignment that Prof gave us. So let's do justice to it. So we are doing portfolio A. Please, we have to be very fast with the figure so that we can leave here on time. This is the only thing we are left with. Return on A, 0.6. Okay, 0.6. And the risk-free is what? Risk-free is 12%. So we have 0.6 minus 0.12 divided by, what's the standard deviation of A? Standard deviation of A is 0.4. Okay, 0.4. Oh, 0.4. Then what about B? Let's do B too. B will be 0.4. So the same thing we have here. Just repeat it. For B, B is 0.4. Okay, then what's the division of B? Standard deviation of B is 0.2. 0.2. Okay. Then what about C? No, standard deviation of B is 0.3. Then what about C? C return is 0.3. Standard deviation of C is 0.2. Then what about D? What about D? D is return for D is 0.42. Standard deviation is 0.18. So this is 0.42 and standard deviation is 0.18. 0.18. Then E, return for E is 0.36 and standard deviation is 17. 0.36 and standard deviation is 0.17. So can you guys help me calculate this? Let's get the answers, please, for each of them. Oh yeah, help me.
First one,
Hello, for
1.2.
A.
First one,
1.2. 1.2.
Yes.
Second
Yes.
one.
0.93.
Well, second one 0.93.
0.93.
Yes, sir. Third one.
0.9.
0. Point what?
9.
Okay. Fourth one.
1.67.
1.67. 67.
Yes, sir.
Then
Yes,
this
sir.
E. This E. E income
1.41.
1.41.
Yes.
Now, another thing I don't know is how we're going to rank. Are we going to rank from the highest to the lowest? Or that's another thing I'm not too sure of. Is it that the one with higher figure we rank first? You know, Prof didn't tell us that. Professor Alabi, do you have idea of this? How do we rank it? Or should I ask? Do I ask?
Why did Professor didn't tell us?
Let me ask ChatGPT, Joe. No need to waste time. How do I?
Yeah, the better actually.
You know, Abi, how do I rank portfolio using the sharp measure? Will the higher sharp measure be ranked higher than the lower? ChatGPT will tell me. Yes, when ranking portfolio sharp measure, on a sharp ratio, a higher sharp measure is ranked higher than a lower sharp ratio. Oh yeah, no need to waste time again. So which one is the highest here? Yeah, 1.67. So this one will be first, followed by what? 1 point something. This is second. Followed by what? This is third. Followed by what? Fourth. And this is what? Fifth. So we have just done sharp measure now. Sorry, is it clear to everybody? Is this clear to everybody, please? Yes. Hello, Esoro. So let's use Trenor. Let's use Trenor measure now. Trenor measure. So for Trenor measure, let me copy this table. So what's the formula for Trenor measure? The formula for Trenor measure is RP minus RF. The same thing, just that you divide it by your BP. Your BP is your beta. You know what they give us beta. So we'll do that. So what is beta for A? What is beta for A? Beta for A is 2.2. So A, it will be 2.2. Please help me recalculate it again. What is beta for B? Is 1.8. I'm deleting, sorry. This is 2.2. And this one is 1.8 is B. 1.8. Then what is better for C? What is better for C?
1.6. 1.6.
1.6, 1.5, 1.9. 1.6, 1.5, and 1.9. So can we recalculate it again? Can we recalculate our answer again?
The first one, 0.21. 0.21.
It's 22, Oga. Check it again, sir.
0.218. Approximately 22.
0.16. 0.3 minus 0.12 divided by 1.6. 0.11. Then 0.42 minus 0.12 divided by 1.5.
0.2.
0.2. Then this one, 36 minus 0.12 divided by 1.9.
0.1.
0.13. So I think the ranking to it will be from the highest to the lowest, Abi.
Yes.
So which one is the highest? This comes first.
0.2.
This comes second. This comes third. This comes fourth. And this comes fifth. Okay. So this is the ranking. Now the last one is Jensen measure. So Jensen measure. So I'll copy my table again. I'll paste it. So what is the formula for Jensen measure? Oh, that formula will be, that one is RP minus expected RP. Did they give us the market? That one is a little bit longer. So our is RP minus ARP. Then our ARP, we have some formulas for it. Okay, this is the last one, Sha. Let's do A. Maybe I'll just do A and B and go. RP minus ERP. Then ERP. ERP is equal to your RF minus RS plus ERM minus RF. So yeah, what is our RF itself? Our RF is 12%. 0.12 minus 0 plus, what is the market returns? Did they give us market return? 0.19. Yeah, 19. 0.19, Abi. Minus.
Yes.
This one again, minus RF again. Is this good? Can this be correct?
Yes.
So what
we bracket beta of portfolio.
So what is the answer here now?
Before we got the answer, we have to multiply by beta of portfolio now. That formula. Check the formula.
Azim, you're supposed to multiply by beta.
By what?
You're supposed to multiply by beta.
Beta of portfolio.
Beta.
Okay. Can you call it for me? Call it for me. RF plus. So yeah, tell me. Maybe I made a mistake.
RF plus ERF.
Multiply by 2.2 after that bracket.
RF plus what? Okay.
Minus
you
RF.
Mean? Okay.
Then bracket multiply by beta.
Is it like this?
Yeah.
Yes, exactly.
Exactly. Yes.
So what is the beta for A? Beta for A is 2.2, Abi. That means I didn't write it correctly. So what is the answer? You know, we are calculating accepted of ERP and calculate by you. So
0.2.
So we'll do 0.19 minus 0.12 times 2.2. Sorry, I'm coming. Plus 0.12. I got 0.274, Abi. So we will not come here itself. So what is the return on portfolio for A? is 0.6.
0.6.
It will now be 0.6 minus 0.274. Then we will now, this is like workings.
0.3.
You get? So 0.6 minus 0.2, 0.326. So that's the answer. So we will repeat this process for all the 5 portfolio. Thank you so much, my people, for correcting me. I think I actually wrote wrong formula. Thank you so much for correcting me. So let's repeat this for B. Okay, we have to finish everything. Let's finish everything. Okay, so if we are to repeat it for B, so our RF is constant, RM is constant. So what is better for B? What is better for B?
8.
1 point what? 1.8.
1.8.
Oh yeah, give me the figure.
0.246.
0.246. So what is the return on B portfolio? What is the return on portfolio B? 0.4. So minus 0.4. This is 0.15154, Abi. Let's do C. What is C? C. So what is the beta for C? Beta for C is 1.6, Abi.
6.
Eh?
Yes, 1.6.
Yes. 1.6.
So if beta is 1.6, can you give me the new answer?
0.232.
0.232.
2.
Oh yeah, what's the return for, what is the return for
0.3.
0.3. Answer.
0.068.
0.068.
Yes.
Oh yeah, let's do D. The beta for D is 1.5.
5.
Question is not, but it's simple to own ourselves. So what is the answer?
0.225. 0.225.
So what is the return for D?
0.42.
So what's the answer?
0.195. We can say 0.2.
No, because of ranking, call 195.
195.
We are going to rank or Kiomalo Jajale. So what's the beta for E is 1.9. So give me the new figure.
The next one, beta is 1.9.
So what is the answer?
0.253. 0.253.
253. So what's the return for D?
0.36.
So what's the answer?
0.107.
So let's rank. So which one will come first? I see 0.154, 0.068, 0.19.
0.33.
No, what is the answer for B? Can I get for B? You know, Equisita. What did you get for B?
0.154.
0.246.
No, 2.6 minus. No, 2.6 minus 0.6. 0.354.
54, yes.
0.154.
3.
No, should be 0. Return on B is what? What is the return? Okay, 0.4. B is 0.4.
Return on B is 0.4.
So what is the answer?
0.154.
So if we have this now, A and B is the same thing. Is it a coincidence? I think I made a mistake. Abi? It can't be the same.
Yes, it's not the same thing, no.
A is 126. A is 126.
The return for A is not 0.4.
326, Abi?
Yes.
Yes.
Okay, so we can rank him. We can rank. And I think here now, A will come first.
1. That's first.
Then 1.5,
Followed by
1.9. This one will come second. D will come second. Then B will come third.
Then E.
Then 1 point. This one will come fourth. And this one is the last. So that's the question that Olawe gave us yesterday that we should attempt. Hopefully, this might also be a shocker for us in the exam. Ojade direct. If it comes out, do you guys like this question as it is? Is it same? Do you like it?
You like
This
it
question
too?
no sweet budget. Oh, I did that because
So Bagbejade ó dùn gan. So Tabale led the more at the portfolio. I think we are good. So guys, let me stop recording now. The class is over. All right. So we started around 3 Abi. So we've done 3.5 hours. So this is actually one of the longest virtual class that I ever done. The highest I've ever done